I fundamentally believe that you can go and try and figure it all out yourself. Or a much easier way, so like a dabbler, again, I remind you, like a dabbler is just going to go out and they're going to try and do it themselves, and then that's going to get hard and they're just going to stop doing it. Okay? Like a stressor is going to go and learn all about it, stress, try to do it all on their own, read all the books, go on all the courses, get all the degrees, and then they tend to break through, but it's a very hard and stressful way. But a master does it differently. A master's philosophy is, who could I model? Who could I copy? Who's already done this before? Because success leaves clues. And ideally, even better, who can I partner with? So today is the essence of us going to the next level. Because I could sit here and I could share with you all the theory, which to some extent, that's what we've done on day 1, day 2. But in day 3, I want to get practical. I want to go and look at what are the top 1% doing? What are they investing in? How are they allocating their assets? I also want to go and look at our family office. So I'm going to talk more about our family office just now, but I've worked with them since 2012, and they work with 65 of the wealthiest families. They manage over $1 billion. Okay. Now you can do the maths if you want to. They are doing things in a way that are different to what the 99% are doing. And so do me a favor from the chat box, just write in the chat. Can you agree that we've got 2 choices in life when it comes to this? We can kind of keep doing what we've always done. We can kind of follow the financial industry. We can kind of follow financial planners. And the chances are we're going to get the same results that I told you on Monday, that 99% of people by the age of 65 are either going to be dead, broke, reliant on the government, or financially trapped. Like, you can love me, you can hate me, but those are the facts. Or we can look at what the top 1% are doing. We can understand what they're doing. We can copy them. We can model them. And hopefully, for many of you, you're starting to realize now that you can even partner with them. And if you do that, can we agree that the chances of the results being similar to them are far higher? The probability, the statistical probability of the results being far higher are much better on this side of the fence than on this side of the fence. Yes or no? Does that make sense? Okay. So with that essence, let's get going. Let's get going into day 3, and let's start to understand how to build a diversified portfolio and asset allocation and everything that comes with it. Now, for the ladies in the house, I always like to start with a little video. So for the ladies in the house, I want to share a video with you. We made this video a couple of years ago. And for me, this video is what it's all about, because we are here to empower everybody to invest like the top 1%. And one of the things that I think where there's a massive opportunity in the world is women, and women feeling empowered. And we spoke, about Veronica on Monday and Tuesday, and a lady in her 50s that wanted to take control of her life, etc., and be, financial freedom, but most importantly, wanted to be financially empowered. So watch this video. And to all the men in the room, how can we empower ladies? Which ladies can we share this with? To the women in the room, how can we make this a reality and truly change the dynamics of women and wealth worldwide?
I remember vividly how I felt when I lost my first tooth, the excitement that came with leaving it in a little box under my pillow, waiting for the tooth fairy to flutter in and wave her magic wand. I woke up filled with anticipation and can still feel the thrill of discovering a 5-rand note in the place where my tooth used to be. Even at that young age, I was contemplating how the gap in my smile was in fact an opportunity to earn extra pocket money. A gap in my smile, but also a gap in the proverbial market. There was something in that experience that made me eager to grow my money without having to wait what seemed like an age to lose my next tooth. As a mom with a smart, curious little girl of my own, I'm often inspired by the audacity and unlimited scope of her dreams, her childlike determination and fearlessness, how she's always searching for opportunities and new adventures. Even now, I'm still looking for gaps, like I did when I was her age, identifying new and exciting ways to grow my wealth. More gaps, more opportunities. I'm thrilled that I found a way to do this with Wealth Migrate. I'm now part of an exclusive circle of people who have direct access to real estate investment opportunities all over the world. Even my daughter can see our investments growing, almost as if by magic, just like that night when the Tooth Fairy visited me. I'm so proud of who that little girl has become. It all started with something as simple as a loose tooth. And today I can look back, having invested in diverse properties all over the world thanks to Wealth Migrate. Join us and learn from the experts that will teach you how to create financial independence. Get informed and motivated in creating your own path to financial freedom. Register today by clicking on the link. This is for young and old alike. See you there.
So, women, what do you think? And to all the men in the house, and maybe Kelly, if you could drop in the WhatsApp group. We've actually got a WhatsApp group specifically for women that really want to focus on being with other like-minded women and being empowered. There was actually a post just this morning, which sure makes me emotional. I was just talking about the wealthiest woman in the world, and it was interesting because 7 of the wealthiest women in the world, 5 of them inherited it. 1 of them married into it, and 1 of them built it. So interesting. I think that needs to change personally. Don't know about you. Cool. Okay. So what is day 3 all about? Okay. So it's about having a diversified portfolio. What we're going to look at is that your asset allocation, like how you allocate your assets, is 85% of your total return. And so we're going to look at asset allocation strategies. We're going to look at the different asset classes and their characteristics. We're going to learn how to create a diversified portfolio, and we're going to start building towards creating a wealth plan. Now, a couple of things to get you set up. I'm not going to go through this in detail, but you know the tips for success. Pay full attention. You know, at the end of the day, you're investing 2 hours in your life here. I know all this stuff. I've trained thousands and thousands of people, probably close to 100,000 people now in 178 countries. I know all this stuff. I'm passionate about it. I'm privileged that I get to share it with you. But if you literally focus, pay full attention, take your little notebook out and make sure you're writing down the notes, share it, commit, have fun, all the things you know. But whatever you do, don't try to be on emails, Facebook, WhatsApp, blah, 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 and think that you're paying attention. This 5 days could be the catalytic change that you've been looking for in your life if you pay attention. You know the resources guide, literally you can go there. Again, if you wouldn't mind just dropping the link in there, Kelly, and we can literally go to the resources guide. Again, Shane is an absolute genius in my opinion, because he makes your life really easy. You don't have to go check your emails. You don't have to go check your WhatsApps. You don't have to do anything. Everything is in one place. If you literally go to day 2, there is day 2. You've got all of the recording. You've got the resource links. I still think Shane is far too kind to you, if you want my honest opinion, because he goes and gives you all the resource links. But you know, our whole philosophy, there's Ann Wilson. There's, if you want my book, Property Going Global, you know, getting paid while you sleep. There's the link if you want it. Joining the different groups, booking a discovery call, the investor strategy, you get the point. All in one place. Now, what's interesting is that we've kind of got a philosophy in our team where we give you everything for free. Because if you want it, go and get it. It's there. It's for free. I'm going to talk a lot about this today. But if you want to be part of a like-minded community, or if you want someone to actually hold your hand and do it with you, for you, then that's how we make our money, just so that you understand that. So you can go do it for free. We live up to our promise that, or our purpose, that everybody can invest like the top 1%, and we make it available to everybody. But if you want to work with us, and you want to be coached, and you want to be mentored, and you want to get the guidance that I'm going to share with you all today, then you pay for it, because when people pay, they pay attention. So it's really important. And like I said, I still think Shane is too generous, but there it is. You've got all the information. We told you where to go and invest around the world. We told you what countries, everything. We've given you all the links to go and do it yourself if you want to. The WhatsApp group is there. The university group is there. So again, you know, my strong recommendation is go and use the group. So, this is a group of over 2,000 like-minded investors. You've got access to the community here. You've literally got everything. It's free. You can go in. You've got the classroom. I'm super proud of the classroom, by the way. Like, you can go read our success stories. So literally go and see real people, real stories. I share a few of them during this thing, but go and look at all of them. I mean, this one that's live here is Billy Selikani. What an incredible guy. One of the most inspirational men in Africa. Literally went from a township to snakeskin shoes and the most highly paid speaker in Africa and the Middle East. And I mean, he's been to our wealth weekends, and this was his experience. So, go read all about it. You can see what you can, expect. But I mean, you better get yourself a cup of coffee, because there are a lot of testimonials. Then if you want to go here, literally start here. I hope it's fairly common sense, but I then take you through, like, what do you need to know? Get started. The 7 lessons. Like, I've done this for 28 years. Trust me, I know what you need to know. And I've literally taken you through 7 lessons. It's about an hour, no longer than an hour and a half. And then what Alex has done is he's literally made it available to everybody. You can go to the investor roadmap. It's 5 simple videos, and he literally teaches you how to go on the platform, how to set up your wallet, how to invest. Every single person on the planet now has access to it. And the best part is it's free. So no more excuses. And if you want to go chat to the community, you can go here, you can chat to them, you can start, you can see the day 2 takeaways and everything that's here. And yeah, well done to everyone else that's put in their key takeaways, et cetera, et cetera. So that's the community. I do want to remind you that you can still upgrade to the VIP if you would like to. Again, what are you going to get in the VIP? Well, you still got 3 days left with me, plus you get all the recordings, plus you get these recordings. So the daily sessions will be up for the week and then they come down. But if you want them ongoing, then you'll be able to get them. And you also get the workbook. Now, something that I'm really proud of is this workbook. I'm constantly evolving and adding to the workbook so that it's just going to get better and better. But when you look at this workbook, I don't know. I learned this from Russell Brunson originally, where I went and I did is it gone now? There it is. And I did one of his free challenges. And then actually I got a workbook and I got to meet him and all that. And that's why I joined the VIP. I told you on Monday about this. But I mean, if you go to day 3, you've literally got everything here. You've got your full breakdown, your asset portfolio, your everything. It's all here. So yeah, there's no time like the present to make decisions in terms of this process. I'm not going to kind of go into all the reasons to upgrade, but I think, having done this 8 or 9 times, I get the most inspiration and value out of the VIPs. That's where people get to ask the questions. Just by the way, just yesterday in the VIPs, we did something which I think would be very, very valuable for people. I'm not going to share it with everyone. Only the VIPs get this. But what I was asked yesterday, and the question we went through is, what is ROI, return on investment? What is cash on cash? What is IRR? And what is yield? And we actually, I added to that, what is cap rate as well. So let me open up. I've got the wrong one open here. So just give me 2 seconds. Because actually late last night, one of the mastermind members asked me to add cap rate, which I did. So I've now added cap rate. So there you've got cap rate. So this is a document that I have shared with the VIP members. And this is the value of being a VIP. So you can see here, yield, cash rate, ROI, IRR, cap rate. By the way, this is the financial language. If you don't know how to speak the language, it's like going to China and not being able to speak Mandarin. So this is the breakdown of what they all are. This is the key difference. The use case, the worked example, so you can understand the numbers, the strengths and the weaknesses, the best practice for investors, final takeaway, et cetera, et cetera, et cetera. So this is the benefit of being part of the VIP, is that I'm always going deeper, and whatever you ask, I try and add value to you. So yeah, if you want to join the VIP, go for it in terms of that process. Now, I remind you why we're here. We're here to build globally diversified passive income and to have portfolio growth. If that's not what you want, then you're in the wrong place. Okay. The formula is to diversify across countries, currencies, assets, partners, and time. And it's all about passive income. And in terms of how you do it, well, any big goal in life, you break it down. So you set yourself a long-term goal. I know Connie, if she's here, her and I did our session just yesterday. And this is why it becomes so powerful, because you literally sit down, if you're part of the mastermind, you sit down with me one-to-one, and we get very clear, what is your top 3 outcomes? What are you aiming for? What does the top of the mountain look like? Then we check in every month. I'll go through this in more detail later today. how do you actually get momentum? And then finally, your tasks and your activities in terms of that process. Just by the way, for the VIPs, just type in the chat box for everyone else. Was it worth it for you yesterday? Like to be able to learn about literally for $47, it's like no money in the world. And to learn the language of investing, to learn the 5 most important metrics to investing: cash on cash, IRR, cap rate, and then basically what the middle class and mom and pop investors use, which is yield and ROI. We kind of chuck that in just for a little bit. So do me a favor, you're all typing their host and panelists, so please make it to everybody, otherwise no one can see what you're saying. So to Connie, Justin, Steve, Nirvana, Alan, Derek, Estelle, please just make sure you type it to everybody, because I want everyone to see the value. And one of the things that I value is that our community, that we work together, like Alan is part of our mastermind, and he asked me to do portfolio planning. And so we did that 2 weeks ago. And just yesterday, someone asked about IRR and cash on cash. So we built that. And we've now gifted them a tool that I think is one of, I've done this so many times now, but I've never had a tool. And I gifted them a tool yesterday that I think is one of the most powerful tools that we've created, along with, there's 2 tools that I think are very powerful. The one is the portfolio analysis, which I'm going to share with you today. And then the second is this language of investing. And again, if you want to be an investor, you have to understand how to be an investor in terms of that process. So let's go and do a little recap of day 2. So what was day 2? Day 2 was understanding where to invest, what countries to invest in. Remember, I only went through residential. There's not time to go through commercial and through alternative assets, although I did cheat a little bit. And, I always like to kind of give people a little bit of a heads up. But if you go here, that was residential. There's the graph. That was commercial. And then that was alternative assets. So yeah, if you want to go and screenshot that, you can go back in terms of the process. And what I shared with you was, where to invest. Okay. Then we went into currencies and what currencies to look at. And I shared with you James Painter, who's a legend. And then finally, I went into assets, and I went into what are the 15 most commonly known assets. What are the rules of what we don't invest in? There were 8 rules, if you remember, that we don't invest in. And again, I learned this from Ray Dalio originally. Anyone that is successful in life builds rules around when they make mistakes. In fact, there's a great book. I can never find all my books. I don't know where it's gone. I'll try to find it just now when I've got I'll look for it just now. But anyway, there it is. Sorry, they've just put an entire new studio in here, so everything's moved around a bit. Anyway, this is the book. So it's Principles, it's Ray Dalio. Create your own principles and get the work and life that you want. So I learned this originally from Ray Dalio, one of the people I follow most and respected most in the world. And he says, look, we're all going to make mistakes. Fine, make mistakes. But when you make mistakes, then make sure that you create principles or rules around it. So like I've made lots of mistakes, and over the next couple of days, I'm going to share with you a lot of those mistakes. But every time I make a mistake, I create a rule, and then I don't repeat that mistake. So that's a strong recommendation for all of you to learn that. And this is a great little book, by the way. Principles, Your Guided Journey. Create your own principles to get the work and life you want, Ray Dalio. Anyway, so then basically I went into the assets we do. And, Ray Dalio says you should pick 15 assets. I gave you 17, okay, because there are 17, assets, and you can pick and choose which ones you want. I'm sure you won't get scolded for using all 17. Okay. I remind you of your homework. Your silver was to fill in your top 5 countries, to fill in your top 5 currencies, and to fill in your top 15 assets. So countries, currencies, and assets. Most of you probably didn't even know there were 15 assets until yesterday. No disrespect. Then you can join the Passive Income Challenge and ultimately go and we're going to talk about that a little bit just now, but you can literally, you can go do it for free if you want to. But if you want someone to coach you and hold you accountable, then you can literally go and do that in terms of that process. And then lastly, share one key takeaway. I can't overemphasize this. You think you're helping others. You're not. You're helping yourself. You're synthesizing your information. You're sharing it. Others can read it. And they're like, wow, like I didn't pick up that part, but did you see that I picked up this part? but the best part is you're actually synthesizing the information for yourself. And thank you, Shane and Kelly, for putting the links in. It's really, really important. Again, you can listen passively if you want to, or you can take action in terms of this process. And then as your gold, you don't need to do it. Remember, gold, you don't even have to do it this week, but I would recommend watching Ann Wilson and looking at that risk tolerance. By the way, that's a free risk tolerance. I'm going to share with you today how, as part of the mastermind, you can actually do your own personalized risk tolerance, which is even a hell of a lot better in terms of that process. And Kevin, thank you for putting it into the chat box. But my strong recommendation for the takeaways, the key takeaways, is go and put it on the Wealth University. Like, go along here to the Wealth University. You'll see here, day 2 challenge, and go and write it down here, because then other people can see what your key takeaways are and they live forever. If it's in the Zoom chat room, it disappears today. Okay. And then lastly, you can book a call. So at any point, if you're feeling overwhelmed, book a call. Now, we're getting to the point where I think the bookings open up from tomorrow. And the reason being is that we wanted you to understand this, to get enough information, because no point in getting on a call and you don't actually understand what to do or the questions you want to ask in terms of that process. So I'm going to have some fun with you today. And I'm going to share with you some real life lessons that I've learned. And we're going to talk about some of the blockages that people don't get. Okay, like what stops them from getting the results. Now, I virtually guarantee you that if you're honest with yourself, one of these 3 excuses you would have used in your past. I know I certainly have, and I'm going to share with you my personal stories. So the first one is that you say, I don't have the money. Okay, so people use the excuse, I don't have the money. The second one is, I don't have the knowledge. Okay, I can't do it. I don't know enough. And the third one is, I don't have the time. Now, what's interesting is the inverse of that is the complete opposite. So there's 3 ways that people get results. And, the kind of the poor people out there, they basically say, I don't have the money. But people that get results change that. They get what they want. And I learned this originally from Rich Dad, Poor Dad, Robert Kiyosaki, where he said, poor people, his poor dad always had excuses, blamed other people, said he didn't have the money, blah, 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 blah. And his rich dad was like, no, I want to do that. I'm going to find a way. I'm going to make it happen. And so, I want to share with you a story that if you've used this excuse of I don't have the money before, I want to share with you the story that will hopefully inspire you. So in 2010, I told you already on Monday, I went to Las Vegas. I paid $15,000 to be at Tony Robbins' Business Mastery 1. And if you've ever been to Tony Robbins, there's always a higher mountain. So he was like, right, at the end of the 5 days, if you enjoy this, why don't you come to my private resort in Fiji? And you're going to be there with my platinum members, which are basically my top members, and it costs $50,000. And I was like, this is 2010, by the way. I'm like, I don't even remember how old I was. I was like 33 or something. And I'm like, 50 what? $50,000. And he was like, yeah, $50,000. But you get to spend time privately with me, Chet Holmes, Keith Cunningham, and about sort of 50 of my other platinum members. Like, remember, I'm in Vegas with like over 1,000 people. And now you're going to get to spend time with Tony Robbins in a classroom environment. I'm like, it's a no-brainer. So I find a way to find the 50,000. You always, where there's a will, there's a way. My father taught me. And so I repeat that, where there's a will, there's a way. And so I found the $50,000. I flew out to Fiji. You know the story, because I ended up becoming Tony Robbins' business partner. But what was more important was that he didn't even tell me something. It was me being in a like-minded environment where it sparked something for me. And at the time, I was helping people invest into Australia, in Australian property. And I used to sell property, and I'd only get paid like 12 to 24 months later. And I found a way, and I'm not going to go into all the details now, but it was a legal way to effectively get paid up front. And that just changed the rules of the game, because I'd never been able to employ good people, because you can't say to someone, work on commission only, but you're going to get paid 10 years later. It doesn't work like that. But when you can get paid up front, you can employ great people. And fast forward a year, I'm literally in New Zealand at the Rugby World Cup in 2011. And this picture on the left here is 100 Mile Beach. And we're literally campervanning around New Zealand. I was at the final of the rugby in Auckland. I took my Kiwi mates along to the final. And what was interesting, while I was on that week's trip, my team at home made 11 sales. And 11 sales to us equated to about somewhere between $110,000 to about $130,000 in money upfront. And so just to kind of repeat what I said, I spent $50,000 upfront with Tony Robbins, and everyone thought I was crazy. My mother thought I was absolutely mad. And yet fast forward, not even a year later, and I'm in New Zealand, and while I'm on holiday, our team made I can't remember exactly, between $110,000 and $130,000. And it all started 100% because I've made that investment in myself. If you want results, get what you want. And I showed you yesterday this little picture, and my son literally made a joke with me last night when I was preparing, and he said, now I know where I get my drawing skills from. But Jill and Joe Soap are sleeping in their bed, and they want to invest in an asset, whatever it is, be it a house or anything else. And they want to basically get paid while they sleep. Now, the problem is they come along to a course, they come to a challenge, they buy a book, they do whatever, and they do all this stuff, and they actually fall off. And so the question that we ask ourselves all the time is, how can we get someone from A to B as quickly as possible? How can we get them a passive income? Now, I shared with you yesterday something that we've been trialing actually, which is what we call our Payday Accelerator. And in our Payday Accelerator, you get 4 things. You get access to the passive income challenge. You get access, which basically takes you through the 4 steps. Sign up, complete your profile, fund your wallet, invest. Now, again, you can go do it for free. We've already given you the links on the platform. You can do it for free already if you want to. But we know statistically that 2.32% of people are going to finish it. So we live up to our purpose that everybody gets access. But quite frankly, I'm here for results. 2.32%, even the South African government wouldn't be proud of as a pass rate. So what have we looked at? Well, we bring in coaches. We have a fully qualified, internationally certified coach who will sit with you and actually understand, what are you looking for? What are you wanting to achieve? Where are you at? What has been blocking you from achieving it to date? And how are we going to help you get there as fast as possible? Then we provide coaching on an ongoing basis. So, number 3 is you've got access to the university so that you've got the whole community and you can be inspired together. Again, I've done my push-ups today. I think it was 185 push-ups today because I'm inspired by being part of a community. And then finally, step 4 is the coaching and the accountability. And you've got an internationally qualified coach, 4 weeks of coaching and accountability to take you through the process. And again, according to Harvard, you've got a 400% better chance of success if you've got a coach than if you do it on your own. I love this quote, by the way. A good coach can change a game. A great coach can change a life. We're going to talk a lot about coaching today. Imagine, what would you like if I was in your corner? Would it make a difference? Yes or no? I've got quite a strong character, as you can pick up. And whether it's the carrot or the stick, I get you results. Now, what's interesting, by the way, I'll take a picture of that if you want to. I think it's a beautiful little quote, that I would, it's sort of quote you should put on your wall in terms of the process. Now, I'm not going to go into all the detail of the Payday Accelerator. I went through that yesterday. And quite frankly, today, I want to focus on investing like the top 1%. I want to focus on being at the level and talking the sophistication of what the top 1% are doing in asset allocation. So this is a simple and easy way to get started. I'm not going to waste my time or your time going through it in detail. If you want to, it's there. By the way, we will be no longer taking this forward, going forward. So from our perspective, we actually are going to upgrade directly to people. You'll either be part of the Wealth Hackers or you won't. And at the Wealth Hacker level is where you'll get the coaching. I'll talk a little bit about that just now. But the point being is that this is your last chance to get access to the Payday Accelerator. It's not a sales pitch. We made that decision last night between Shane, Alex, and myself in terms of that process. I do remind you, because I did talk about it just yesterday, all of the things that you get in the Payday Accelerator. So you get the passive income, which gives you the 4 steps. So passive income, you get next steps, you get knowledge, you get results, you get freedom, and you get the system. And then the bonuses, you get the freedom calculator, which is clarity. You get the wealth plan, direction. You get the wealth roadmap, which is hope. You get the confidence. The most important thing you get here is the coaching and accountability, which gets you the results. And then I'm also going to do the fast action bonus, which is the insight. So the total value is $3,000, and you can literally get access to it for $97. And again, I know it sounds like a sales pitch. it truly isn't. We're not going to be continuing with this. You're either going to get free access at the investor roadmap, because what we've learned from Alex is that we just want to give it to people for free. There we are, go along, do it for free. We don't, like, no disrespect, but we don't want to waste Alex's time and the rest of the team members. So you've got access, go for free. If you want to be a wealth hacker, which is what I'm wearing here, which is our digital community, then we'll provide the coaching and or join the mastermind. 3 simple options for everyone going forward. So yeah, use this, don't use it, but you won't see it again, in terms of the process. Okay. So 3 ways to get results. Get what you want. So don't use the excuses. Get what you want in terms of that process. Number 2, get the knowledge. So, again, you can go try get all the knowledge like I did, and you can go do all the courses, do all the degrees and everything else, or you can do it through partnership. And hopefully we've been through that in quite a lot of detail already as to how you do that. So let me share with you a story here. This is a property. So in 99, I'm sitting in a pub in Rondebosch, Cape Town. If you're from Cape Town, you'll know it. It's called Forest. And my mate comes up to me and says, "Oh, my granny wants to sell her house." And I was like, "Wow, that's an amazing location right next to the university. Why don't we buy it?" We're 22 years old, by the way. And so anyway, so we didn't have any money. How many of you are like, "I don't have money to buy houses"? Well, I didn't have any money. I was 22 years old. Living in London. I just paid off my student loan. I was literally first year out of varsity. And anyway, so I was like, but where there's a will, there's a way. So we went out and we secured the deal. We got 2 people to put in the deposit. We got the mortgage and we bought the house. And then we found out that it had R4 zoning, which is incredible zoning. So it's not just a house, because we were just going to put tenants in it, but actually we could develop it. So originally we looked at building 38 units, but it was right on the Liesbeek River, which had water issues and all that. And so we finally settled on doing townhouses. Now, some of you are going to go, "Wow, that's so clever of you to figure that all out." Nope. What we did right in the beginning was we went, right, we've secured the house, we own it, so you can't steal it from us. And we went to a developer and we said, "Listen, you're one of the best developers in the southern suburbs. Why don't we partner on this?" And we went 50-50 on the deal. We built 6 townhouses, we sold them, and we made 2 million rand each. This is 1999, I was 22 years old. Well, we bought the house in 22. I was probably 24 by that time. But, 2 million rand each is not bad for someone 24 years old. And in, dollar terms, just for those that are overseas, in those days, that would have been maybe $250,000. I don't know the exchange rate, but the buying power would have been, maybe, I don't know, $300,000-$400,000. I don't know. It was a lot of money for a 24-year-old. But we did it all through partnership. I shared with you the story of Richard Branson. And funny enough, Shane, if you're listening to what I'm saying here, I'm selling myself on why I need to go on that investor trip with Robert Kiyosaki, because this is what I've done all my life. It's if you want to be put yourself in the right environment, that's where you make things happen. And so that's why we created the Wealth Hackers. And it's something that I'm super proud of. It came from Necker Island with Richard Branson. And what is it all about? Well, in simple terms, it's the Netflix for wealth, and again, just to give you some statistics here, because I think this is really important. So a bird flying in a flock can fly 70% further than a bird flying on its own. Okay, that's interesting. Okay, it's the laws of nature. A shoal of fish swimming, like that's why they swim together. The bucks going across the plains is more efficient when they're together. Okay, so can we agree the laws of nature say that when animals work together, they've got about a 70%, they can go 70% further than they work on their own. Okay, that's a law of nature. It's a fact. Now, Deepak Chopra, that's one of the most famous people out there in terms of humans and human psychology and everything in between. He went and did research and he said, if you try and do something on your own, you have a less than 50% chance of success. So as an example with us, our passive income challenge, actually when people have done it on their own, I mean, it's 2.32%. I mean, it's ridiculous, okay? When you do it together with a husband or a partner, a friend, or whatever, a wife, obviously, you got about a 60% chance of success. But when you do it in a like-minded community, you've got a 70% chance of success. Now, I ask you the question, and please put it into the chat box for me. Do you think there's a correlation between nature's laws of a bird flying at 70% and Deepak Chopra's research that also comes at 70%? Do you think that's a fluke, What do you think that's based on fundamentals of life? Because I can't prove it to you, but I think there's a correlation in terms of those two. And that's what the Wealth Hackers is all about. Because like I said to you, and I literally said this to you on Monday morning, you got the choice. You can do it all on your own, and you can stress. By the way, the dabblers are gone. Stress, and try to do it all on your own. You can be part of a like-minded community where it's you kind of do it together, which is what our Wealth Hackers is. Or you can say, nope, I want it done for me. I want it done with me. I want someone to actually one-to-one hold my hand. And that's what the mastermind is about. And we'll talk later about that today. But for us, Wealth Hackers is our digital community where we all work together. And it's a group of like-minded people. And the reason we use Netflix is that I love the concept of Netflix. Rather than trying to buy one course here and one course there and all this sort of stuff, imagine if it was all just in one place and you could kind of work through it and do different courses when you need it. So I shared with you yesterday and all about what countries to invest in, what currencies, how to choose the right assets. We call it literally wealth going global. And you can see here, you've got the power of clarity. How do you find your why? You've got how to choose the countries, how to choose the currencies, how to choose the assets, how to choose the partners, how to build a plan over time, and how to do it with smart investing. So what you'll discover in this is literally how to build a globally diversified passive income and portfolio growth simply and safely without making the mistakes that others make when trying to do it themselves. And again, Shane's given you the free version. You can literally go and fill in this investor strategy sheet if you would like. But Wealth Going Global obviously takes this to the next level. So the first part is the power of clarity. And that's where I sit down and I help you come up with your 5 whys. What are your top 5 whys? And why is this important to you? Because when you have your whys, you can push through anything. The next one is the countries. We literally go deeper on the countries and we help you uncover where to invest, not just in residential, but also in commercial and in other alternative assets. Then we go to currencies. And I already shared with you, this is where James Painter takes you through the currencies. You know, crypto as an example. Which crypto should you look at? Which currencies? Pound, dollar, euro, Swiss franc, Japanese yen. Where should you be investing? Which currencies should you be investing in? Then we go into assets. Which assets should you be looking at and how do you build your right portfolio? And I go into a lot more detail around what are primary and secondary markets? What is asset allocation? What are the top 15 most recognized assets? The 8 golden rules, and then the top 15 asset classes according to the data. Then we go to partners. Now, tomorrow I'm going to teach you about partners, but we go a lot deeper in terms of partners. How do you find the right partners and invest with confidence globally? Because it's all about finding the right partners. Literally, you're going to be as strong as the partners that you choose. And then finally, it's about time. And this is about literally bringing it all together and building a portfolio. And like we're going to go into this today and on Friday around building your plan. And it's basically about walking away with a wealth plan and an investor strategy sheet. And then finally, as a bonus, we bring it all together in terms of smart investing. And in simple terms, how do you use technology and smart investing to, help it make it easier, simpler, safer in terms of that process. Now, if you look at the value of this and the total product that we've put together, the value is if you were to learn and basically take what others have paid, it would be for Property Going Global. When I wrote the book, it was literally $30 when I launched the book. Then you had the buyer's trips, and people have paid sort of, generally between $2,000 to $5,000 to come on a buyer's trip with me between America, the UK, and Australia. You've got the due diligence. Now, this is where we've invested literally millions of dollars in doing due diligence. And generally on a project, we could spend up to $250,000 just on due diligence. In fact, the German deal that we did last year, the gentleman that we partnered with spent 320,000 euros, just to give you an example of what I'm talking about. And then even when we launched the mastermind, it's no longer at this price, but when we launched it, it was $5,000 in terms of the process. That's what others have paid to go through this process. Now, if you take everything that you get at Wealth Going Global, you get the power of clarity, countries, currencies, assets, partners, time, smart investing. You also get Clem Santa, the Q&A, the cheat sheets, you get the access to the calculators, and you get the VIP entrance to the events. If you take all of that value, it's actually over $8,000 worth of value. And when we launched this 2 years ago, people actually bought it at $4.97. So where's it gone here? So literally, it was $8,000 worth of value, and people bought it for $4.97. I've got a little secret to tell you. I'm going to be relaunching Wealth Going Global on the 22nd of July. And what I'm about to share with you, anyone who signs up today is going to get it. They're going to be able to join me live when I redo it. So I did it live 2 years ago. We got phenomenal feedback, but it's time to redo it. And I'm going to be redoing it live on the 22nd of July, literally in 6 or 7 weeks. Now, basically, people paid $4.97 to be part of it. Then the other part, so remember, that's the right information. Then on the other side of the fence, you've got asset class mastery. This is all about the right partners. So what are all the different asset classes? But most importantly, how do you find all the right partners? Where do you actually go and invest with the right partners? So that, if you put that together, because that's about 90 minutes to 2 hours on every single asset class, but most importantly, introducing you to the right partners. I mean, as an example, just the one on data centers. Well, just yesterday, you met Gary Sachs. Like, just imagine having the equivalent of a Gary Sachs across all of these different asset classes. Now, the value of that is $14,900, just short of $15,000. And literally, people paid $1,997 for it. So that's what people have paid to get access to asset class mastery. And so what we did when we decided to do the whole Wealth Hacker and Netflix was we took both of them and we put them together and we said, right, if you just paid for those two courses, it would be worth $2,494. But what are we going to do? We want to go out and build Netflix. So we want to literally Netflix for wealth, if you want to call it that. So we want to build this Wealth Hacker community. We want to keep building the Netflix for wealth. And so we started adding to it. And we said, right, you got Wealth Going Global, which is the right information. You've got Asset Mastery, which is the right partners. We then added Clem Sunter. We added the Q&A. These are live sessions with Clem Sunter. We added the 6 pillars of wealth, which came from our family office. We then added Enneagram and Wealth, which is an amazing course. It's the oldest profiling system in the world, and it's all about who you are. And it's amazing. Karen and Bianca are incredible. And the Enneagram Wealth is something that we're actually in the process of patenting. So you can't get it anywhere else in the world other than through us. And it's using the oldest profiling system in the world to understand who you are as an investor. What mistakes have you made in the past? Why have you made those mistakes? And most importantly, what are the right investments for you going forward? Then we've got a session from a gentleman in Ireland on how to teach your children money. I mean, one of the most important concepts. We've got generational wealth. I mean, how many of you would like to literally teach your children about money and to be able to hand over to your children and your children's children? This is about your legacy. We brought in a guy called David Lipschitz. He charges $250,000 per family. He lives in New York, in America. And but we managed to get him to do a training on generational wealth and the principles. Then you've got effective tax structuring and estate duties. You know, and it's interesting because I get asked all the time by people, oh, but I want to know about the tax. Great. We brought in our family office and we said, right, what are the principles of tax that you need to know? Structuring and estate duties. That alone is worth $20,000 just on its own. You know, that's what you would spend easily if you went out and went to try and go and talk to tax consultants and to understand if you're wanting to build a globally diversified portfolio, what do you need to know around tax and structuring and estate duties? We've got access to the entire wealth weekend where we go into the 6 mega trends, the Enneagram wealth, generational wealth, and everything in between. People paid $9,000 to be part of that. And then you've also got exclusive access to the community, which is the Wealth Hacker community. Now, if you put that all together, the total value is over $60,000. And by the way, we're adding to it all the time. So whenever we, do a new course or a new thing, then we add to it. Now, the reason that the things are in blue is that you've got two options. You can pay monthly or you can do annually. If you do annually, then you'll get access to the new Wealth Going Global. So I'm redoing it on the 22nd of July. It's already all organized. And if you pay annually, you'll get access to that. If you pay monthly, you won't. So anything in blue, you won't get access to if you pay for it monthly. So if you pay for it monthly, you get everything in yellow. And if you pay for it annually, you get everything in blue. Okay. Now, I've told you many times, we live on Zig Ziglar's principle. You can have anything you want in life if you help enough other people get what they want. So we want to make this as affordable for people. And so for us, our Wealth Hacker annual subscription is $356 a year. Now, I remind you, just if you're a mathematically minded person, I told you already that when we launched Wealth Going Global 2 years ago, it was $497. Okay? The chances are it'll be at least $497, if not more. We haven't finalized the price, but it's going to be somewhere between $497 and $997. If you sign up for the annual Wealth Hackers today at $356, you will get Wealth Going Global for free, and you'll be able to join me live in terms of that entire process. You'll not only be able to join me live, you'll also be able to join me for the live Q&As through the entire process. So it's just, by the way, I haven't even spoken to Shane or my partners about it, but him and I had a conversation last night, and to me, this makes it a no-brainer in terms of people being able to participate. So just to remind you what you get if you're part of the Wealth Hackers. You get the ongoing course and trainings, which, we keep evolving them in terms of that process. And again, it's $356 a year. You get things like the Enneagram and Wealth. You get access to the effective tax and structuring, estate duties, and how best to earn a globally diversified passive income. You get all the stuff around generational wealth. If you look at what David shared here, the essential components of building and sustaining generational wealth, strategies to align wealth with life goals and family values, insights into managing financial, social, and experimental capital, techniques for effective family communication and decision-making about wealth, practical advice on navigating family dynamics and intergenerational relationships, and steps to create lasting legacy that benefits future generations. You also get access to the events. So what I think, and by the way, we've just invested about $12,000 recently in a company that is teaching us best practice. And so if you go to the classroom here, you've got access to all of the different courses. So you've got some cool stuff there. You've got Wealth Going Global, you've got Asset Mastery, you've got Clem Santa, you've got 6 Pillars to Wealth, you've got the Enneagram and Wealth, you've got How to Teach Your Children Money, you've got Generational Wealth, you've got the Effective Tax and Structuring, you've got the Wealth Weekend. There's a whole bunch of things. 10 lessons I've learned from personal development, 16 macro. You can see I'm adding to it all the time. But what's more important, in my opinion, is that what we've done now is we invested $12,000 in ourselves. You're going to hear me say that over and over again, because whenever I invest in myself is when I make measurable progress quickly. Okay, so anyway, so I invested in myself. We as a company invested in ourselves. And what we've done now is we've opened it up. So every single Wednesday, you've got Alex, my partner, who's there for a coaching and accountability session. And every single Friday, you've got me to come and ask questions. We call it Wealth Strategy Friday, weekly wealth strategy. So you can literally go along here and be part of it. So this is like an ongoing thing. And that's what I mean by access to the events and everything else. Whatever we do, whether it's Clem Santa or anything else, you've got access. Even this challenge, you would have automatic access to the VIP. So if you're sitting there going, maybe I should join VIP. Well, if you join Wealth Hackers, you get access to the VIP for free. And it's literally $356 a year. And for those of you that are sitting there going, I'm not sure. Well, there's actually something really awesome where literally Richard Branson said, when I started out in my career, I quickly realized the community means everything. Having a mentor in Sir Freddie Laker when we decided to start Virgin Atlantic was also critical to our success. If you're an entrepreneur, one of the best things I can tell you is don't do it alone. Well, I completely agree with them. I also believe that as an investor, it's exactly the same in terms of that process. So again, you've got your own private community, the Wealth Hacker community. We've got the school group. We've got the WhatsApp group. And for those of you, if it doesn't already sound, amazing, you can even go and try it for free. So you can literally go to the link, diversificationchallenge.com/wealth hackers. Thanks very much, Kelly, for putting it in there. And you can literally go along and you can even give it a 7-day free trial. So you can go in and if you literally sign up, you've got 7 days to try it for free. So that's how much we believe in what we do. We know it works. We know you're going to get value, and you can even go and try it for free. So a bit of a no-brainer if people want to participate. And like I said to you, I know it feels like a bit of a sales pitch. It's really not. I literally thought of it last night, is that I'm going to be doing Wealth Going Global live on the 22nd of July. And there's someone signing up. And you do get a 20% discount. So if you join up annually, you get a 20% discount. So this is important, okay? You can pay monthly, no problem. But if you pay annually, you get a 20% discount. You also get access to the live training of Wealth Going Global, which starts on the 22nd of July. You get the effective tax and planning, the tax planning structuring, and you get the generational wealth. Those things are not available if you pay monthly in terms of that process. Okay. And that's, you can go again and look. If you want to, you can go to that link and you can see what all the different people have to say about it in terms of that process. Kevin, if you just reach out to the team, no problem. We'll make sure that we'll get you sorted in terms of that process. Okay, so you can go and watch what lots of other people have to say. Now, what I basically said to you, these things get a bit irritating as people sign up. But anyway, well done to all the people that have signed up. It clicks through and it's yeah, sometimes it can irritate me a little bit, but anyway, it's a sign that people are taking results, which are taking action to get results. So I remind you the 3 ways to get results. Get what you want, okay? And secondly, get the knowledge that you want through partnership. Now, I want to take this to a whole nother level because we're now going to share with you what the family office is doing. And this is not going to be financial advice, not from me nor the family office. But today is all about asset allocation. And again, if you're going to get the knowledge, you can try to figure it out all yourself, or you can literally go and copy what the wealthiest people are doing. So we've said that you need to diversify across countries, currencies, assets, partners, and time, and it's all about passive income. But now it comes down to your asset allocation. How do you actually choose where to invest and what to invest in? Now, there's a guy called Mark who's out of Australia who I really like, and he talks about the pyramid. So building an asset allocation out of a pyramid. Ann Wilson, she also talks about the pyramid and the fact that the pyramid is the most resilient structure in nature. So this is all about asset allocation. But for me, the one that I enjoy the most is the wealth report, because the wealth report goes out there and it's from Knight Frank, and it literally looks at some of the wealthiest people in the world. So there's 579,000 people that are the wealthiest people in the world. Okay, so it's the top 1% of the top 1%. They've generally got $30 million or more. And they look at and they go out to all the family offices and the high net worths, and they basically ask them where they are investing. And this report comes out once a year. And actually, interestingly enough, this was a video, and I'm not going to play you the video, but this was a video that we did live with the lady that actually runs the Knight Frank report and does all the research. And I got her to come and speak to our mastermind and teach them about all the trends and everything that was important. But what I love about it is when they did the report, they brought out what is the asset allocation. And what is so interesting here is that if you remember back to Monday, the average person, according to their financial planner, has about 30% in bonds and about 70% in stocks. So they have 100% of their money tied up in the secondary market, basically in the stock market. Okay, now, if we look at the top 579,000 wealthiest people in the world, this is how their wealth is allocated. So they've got money in their primary and secondary homes, 32%. They've only got 26% in equities. The average person has 70% in equities. They've only got 26%. They've got 21% in commercial property. They've got 17% in bonds. They've got 9% in private equity. They've got 8% in commercial property indirectly through funds. They've got 7% in other. They've got 5% in commercial property indirectly through REITs. They've got 5% in investments such as art, cars, wine, etc. They've got 3% in gold, and they've got 2% in crypto assets. Now, just my interest, if we look on the right-hand side here, if we compare that, in primary, they've got 72%, and in secondary, they've got 28%. So remember I said to you just yesterday, or was it on, yeah, yesterday, you know, the average financial planner has most of your money, if not all of your money, in the secondary markets, and yet the wealthiest people have more than 70% of their money in the primary markets. And you know what's interesting? And please type in the chat box here your thoughts. I'd love your thoughts. is that in times of stress, where there's a lot of uncertainty, like there is in the world right now, do you think that people, the wealthy people, the people that have $30 million plus, do you think that they put more money into the stock market, or do you think they put more money into assets that are safe? Which one do they do? I'm gonna have a sip of water while you answer that. Yep, everyone's writing assets. So they put them into primary market assets. They put them into real assets. Remember, the stock market is secondary market. It's paper assets. It's not real assets. Whereas the primary market is real assets. This is a real asset. This is a house. You can see I'm hitting it. It's a real asset. And so in times of challenges and uncertainty, they go into real assets. And you can see it. I mean, look at this correlation, 72%. So there's a gentleman, and I think he's online actually, Alan, who's part of our mastermind. He asked me a question. And he said to me, Scott, I want to know what would be the asset allocation like for the different, even for different age groups. So we went and we did the research, and we literally went through it. And we said, right, I want to look at the historical data over the last 50 years across the different asset classes. I want to take modern portfolio theory and lifestyle. You're about to learn about this. And I want to take the current macro trends of inflation, volatility, rising interest rates, technology, shifts in global real estate, capital markets, etc. And then I want to look at risk, liquidity, income requirements, inflation, capital preservation, and legacy planning. These are all the different asset classes that I want you to look at. And then I want you to do this based on age, 20s, 30s, 40s, 50s, 60s, 70s, 80s, etc. It then came down with key rationale, asset classes, and then finally, like your whole portfolio. It shows you that this is not financial advice. And then ultimately, now, why is this important? Because I'm going to go through this with the people that are in the VIP, or for the people that have already figured it out. If they join the Wealth Hackers, they can join me in the VIP as well. But the point being is that I'm going to go through that in our VIP session. For the rest of you, you can screenshot this. And by the way, I'm going to give that as a tool for the Wealth Hackers and the VIP members to be able to use. Now, when I went hold and I spoke to our family office, because we're about to go to a family office now, and I said to them, hey, what do you think of this document that we've kind of put together? So that's the document on how to structure your portfolio. And they said, yeah, look, Scott, it's great. But, we prefer to work with people one-to-one. So, what is a family office? And just of my interest, who here has heard of a family office before? And if you haven't, then just, say, no, I haven't heard, or no, I haven't, or no, whatever. I'm just interested, how many people have heard of a family office? Yes or no? Okay. So I can see Sylvia said no, Kevin said no, etc. Okay. So I did a thing on Investopedia. A family office is a private wealth management firm established by ultra-high net worth families that provides a family with a selection of personalized services that include investment management, financial planning, estate and tax planning, philanthropic investing, concierge services, and more. Who needs a family office? And they go on to say, someone with $250 million or more. Now, I've got some good news for you. We have democratized, like everything else we do, we have democratized access to a family office. And anyone that joins our mastermind actually gets access to our family office. So the feedback the family office gave me on this report that I just told you about was, it's great. And it all makes sense, but we prefer to sit down with people in a one-to-one environment to be able to help them come up with their own personal plan. Now, here's a little video. It's a short little video. I just need to make sure I'm sharing my sound. It's a short little video that just shares with you why this is so important in terms of asset allocation.
This doesn't change, guys. Asset allocation, and this is not all of the asset classes we work with, but asset allocation is going to account for 85% of your return and is the fundamental building blocks of asset management and a financial plan that's going to, produce income or anything. But Anthony's going to talk to this, and this will give you very specific kind of views around the returns, the averages, and where we think the value lies.
So that's Garth Wellman. He's the CEO and founder. And what he's basically saying is that 85% of your long-term returns are going to come down to your portfolio construction. And so I'm going to share with you 2 videos now. The first one is a little interview that Garth and I did on what is a family office and why are they different from a financial planner. And it's a short little video, and I think it's really important that you understand it so that you can start to understand the difference between what you are probably getting and what you should be getting. Okay, so while you're listening to this interview, just think, imagine if this man and this company was in my corner helping me. And then after that, I'm going to teach you, I'm going to share with you Anthony, who's going to be taking you through the 6 pillars to wealth. So whenever they sit down with one of their clients, one of their family office clients, they take them through the 6 pillars to wealth. Who would like me to share with you the 6 pillars to wealth that Anthony and the family office take every single one of their wealthiest clients through? Just type in the chat box if you'd like me to share. If you don't want to, it's fine. I've done it lots of times. I know it personally. I'm trying to implement it in my own life. Okay, so let me share with you the video that Garth and I did that just explains to you what a family office is, and then I will share with you the 6 pillars to wealth.
The family office is typically a full financial management of a high net worth individual's affairs. Typically, a wealthy person would set up a family office to administer everything in-house. You would bring in, legal attorneys, private equity, and construct a full suite of investment services, from offshore structuring to offshore legal advice. So we set up a family office to be an outsourced full financial services provider outside of the scope of just investment management. And that's what we brought to the table. And we realized that we wouldn't do that for a single family. And that was where we said we became a multi-family office. Our services were well outside of the scope of what a financial planner would do.
Well, talk to us a little bit about that, because most people, including me, only really understand a financial planner or / an investment bank. Maybe you've been invited to the private banking of investment banking, etc. What is the difference?
Oh, look, a financial planner is one service of probably 15 or 20 that a family office does. A financial planner effectively looks at a person's wealth preservation or their wealth creation. He goes, how do I create more wealth if a person hasn't yet got sufficient wealth? And he goes to the typical listed market space. And if he works for an institution, he goes to his employer's institution and offers their products as a solution to create wealth. The more sophisticated financial planner is the one that's working with the high net worth and saying, well, here's how we can preserve wealth. And that preservation of wealth then comes in the form again of the same financial products, sometimes slightly more sophisticated, a little bit more on the offshore side. He's not often involved in the actual legal structuring, and that is just outsourced by the bank to alternative companies. So very little of what a sophisticated financial planner does really goes into him being involved in the taxation, the immigration, the international tax planning, international business, corporate advisory, resolving tax issues, staying current. So I think a financial advisor is largely connected to creating wealth and using listed investments, and protecting wealth using listed investments, which is just one very small part of what a family office really does and is capable of doing with in-house services.
If you're working with some of the wealthiest families, around the world, why would you work with me? What's the reason for that?
Yeah, Scott, I've said it before. You can build scalable businesses, and, I'm both a financial person and an entrepreneur. But what I started picking up is I don't think good advice should be the domain of just the super wealthy. Okay. And one of the greatest problems the world faces is wealth disparity. Where 99% of the wealth is held in 1% of the world's population hands. And we know that's one of the biggest problems that has to change. But the same with advice. The wealthier are, the higher the quality of the advice, the more access you have to deals, the more access you have to create more wealth. So, in our universe, we want to create opportunities for a much broader, much more scalable, suite of wealth and investors, for example. So I really want to see people that are hungry to learn. So for me, I'm looking at this and I'm saying, if we can teach the secrets of that 1% to 25, 30% more people, we create a much more sustainable world and a much more sustainable economy. So yeah, I think that's where, where you and I have worked really well together is to create scalable but high-end information being accessible to other people rather than just the 1%. Yeah. And also, with the 65 clients we have, 70 clients, I mean, it grows all the time, I haven't counted, families that we have, so much opportunity exists within that for us to, to spread that opportunity and create a real symbiotic environment for wealth creation and transfer of knowledge. Wonderful, Scott. Thank you for that. And yeah, it's been a great journey, and it's always so rewarding to hear compliments from your clients. And yeah, long may we continue to, teach and grow people.
So what do you think? Can you now start to understand the difference between a family office and what you traditionally get in terms of, a financial planner? So let's go a little bit deeper. And I'd like you just to consider, like, would it make a difference if you had this team? So you just met Garth, now you're going to meet Anthony, and they've got a whole team of people behind them. But every single month, Anthony comes in and teaches us. So as part of the mastermind, he teaches us, what do we need to know in the markets? What's going on? What's happening with interest rates? What's happening with, inflation? What do we need to know? And so we take this learning and we take this growth, and then based on what we learn, we then adapt and we back to the 6 pillars of wealth, because this is how you build not only wealth, but generational wealth and legacy. And so it's really important. So I'm going to share with you this video. No one's ever seen this video before, other than the mastermind members. So I'm pretty excited to share it with you. And this is the 6 pillars to wealth. And while you're watching this, I really encourage you to take notes and keep asking yourself, what would it mean to me and my family if we had these people in our corner? And I'll share with you afterwards how you can have them in your corner. It is time to pivot to Anthony. And this is a really interesting concept. We did this previously. We did this in October last year. It was the first time that Anthony did it. And to give you the backstory behind it, was I was sitting with Anthony and Garth. They were talking about asset allocation, and they said something really pivotal. They said 85% of your total returns are going to come down to your portfolio construction. And again, a lot of us just assume these things. We say to ourselves, okay, well, I know what Anthony means. And when I actually kind of asked the questions, I said, what does portfolio construction actually mean? And Anthony said, no, well, there's 6 pillars to, portfolio construction. And so back in October last year, Anthony actually shared with our mastermind community what are those 6 pillars to portfolio construction. And then when we did the wealth weekend in, when was it now? March, we actually spent the entire weekend just going into each one of these 6 pillars. So I want to be very clear. This is a topic that we could spend 1 hour on, we could spend 10 hours on, or we could spend 10 days on, in terms of the process. And I think, Anthony, when I reached out to you and just getting feedback from a number of the mastermind members, this is one of those moments where, to some extent, if you've seen this, then repetition is the mother of skill, because effectively it's a 1-year upgrade. If you haven't seen it, it's an invaluable pillars and foundations that you need to know. And I think there's 2 things that I would ask people to really be looking at. One is, what does this mean to me? And do I have my pillars in place? And if not, what do I need to do? If you've already heard the talk, and if you haven't, then it's a case of, well, what do I need to know? And it gives you a much better idea of how we work with our family office to help you set you up for success. And then I think there's one third component that I just said to Anthony, because I know you always like flippantly throw it out there with the buckets. And it was the people that only got the wealth weekend that got the whole bucket thing. So for the mastermind members, I want to go a little bit deeper around what are those 6 pillars and how do you use your buckets, etc. But it's without further ado that I'm deeply excited to go back to you, Anthony, because I know what you're about to share is literally the foundations. I love metaphors of buildings. And if you're going to build a tall foundation, you have to have a strong foundation. And, why we keep repeating this is because it's the strength of your foundation which is going to help build your building,
100%. Thank you, Scott. I think that was a great introduction. Can I go now? You basically summarized the whole thing.
You're all good, dude. That's over to you. I'm going to switch my camera off because it's all about you now.
100%. Okay, I'm going to share my screen again. I've made some updates to these slides actually as we kind of incorporate new things into the process. So there are 1 or 2 new parts of it, but ultimately what we're dealing with here, as Scott said, is portfolio construction and the fundamentals which get you 85% of your returns. In the presentation, I will touch on 6 key pillars. Firstly, one's time horizon. Secondly, the risk tolerance. One's asset allocation, diversification, personal outcomes / goals, and then the monitoring, measuring, and rebalancing. The chart at the bottom, the multifaceted approach, is something I'll touch on now. It ultimately relies on 3 pillars to build that portfolio construction, of which these 6 topics slot in. But ultimately, you've got your Enneagram profile, you've got your asset liability modeling, and your individual circumstances. Those come together to form the portfolio construction. Today, I'll touch on the asset liability model side of things, as well as the individual circumstances. As most of you know, the Enneagram side of it is equally as important, but I won't dive into too much detail around that. That has been handled or touched on in other webinars. And like Scott said, there are recordings and stuff as a refresher for that. When we look at time horizon, it's probably one of the key driving forces behind planning and investments, right? You'll always hear, time is your best friend when it comes to investing. The longer your time horizon, the longer your ability to compound your capital, and the greater that sum of capital can become at a future date. When we look at the time horizon, it's important to understand our current situation relative to where we want to be. To do this, we use something called an asset liability model. As the name suggests, the asset liability model looks at your current assets relative to your liabilities or future liabilities. Typically, those future liabilities are in the form of income requirements, or income drawdowns that you will need to take at retirement from your portfolio. And the asset liability model is all about planning for retirement or planning for some kind of future event now. It doesn't need to be retirement. Some people are already in retirement. It can be legacy. It can be saving for certain things, which I'll touch on later. But ultimately, it's the framework or the base from which we work on to build portfolios. When we look at defining the parameters of the asset liability model, it's also important. So what I've done here is I've included snapshots around those parameters, right? So I think when I run through this, my goal is for you to understand the effect that each of these parameters have on the asset liability model. Now, I've taken a very basic example just to get the point across. Obviously, this is all unique and tailor-made to each individual. We typically find that no one client is the same. Everyone has different parameters or outcomes or goals that they're trying to achieve. So it's not a one-size-fits-all, but by understanding the different parameters, you get a much better understanding of how this works and what it relies on. So firstly, we look at the current age. In this example, we've assumed Joe Soap is 45 years old. They plan to retire around 65. and they have protected years of 35. Protected years, I think current age and retirement age are very self-explanatory. Protected years is an important one because ultimately we're always looking to build sustainability in these portfolios or in your portfolio up until age 99 or age 100, right? The reason why we do that is because modern medicine has got really good, and some people are actually living to those ages. Importantly, we're always looking to take care of the breadwinner first, and make sure they've got sustainability of their capital or enough capital to see them through to those later years. And secondly, if one were to pass away prior to age 99 or age 100, then the leftover portion essentially starts to form part of your legacy or your inheritance. So those who have dependents or kids or things like that, by planning to the later years, you're naturally taking care of that bucket, right? The years of saving, in this particular example, is the difference between the retirement age and the current age. The model assumes that over those 20 years, you are in a financial position to contribute to your portfolio, or at a bare minimum, not withdraw from your portfolio. So not make physical capital withdrawals in that time period. Things like interest and dividends and stuff like that are slightly different. That's obviously an interest earned from the portfolio and can be accessed. But ultimately, you don't want to put pressure on the portfolio until such a point that you need to. And typically that point is retirement. Now, retirement can mean two things. It can be physically when you retire from employment, or it can be a point at which you start to make withdrawals from the portfolio. They don't need to be the same thing, but more importantly, it needs to be a point where the portfolio starts to come under pressure, or in other words, starts to physically make income payments. We make some other assumptions. We look at inflation. In this example, I've got inflation at 4%. I'll talk you through what that means shortly. We assume a return pre-retirement, i.e. those 20 years from age 45 up until age 65. We make an assumption there around the return. And then we also make a return assumption post-retirement, and that will be essentially from age 65 in this example up until age 99 or 100. The reason why we scale back that return in post-retirement is due to we just try and dial back the risk profile a little bit. So maybe as an assumption, you're a pure equity investor up until you retire, and then you need to kind of take your foot off the gas a little bit because you can't have as much volatility in the portfolio or assume as much risk. So we just tend to dial it back there a little bit. Again, everyone's unique circumstances will differ. There's no one size fits all. In terms of our inflation number, inflation in the model assumes the increase in income that you derive from your portfolio on an annual basis. So in other words, each year, we assume that income amount will increase by inflation, right? The reason why we do that is to ensure that when you're drawing that income in the future, let's say 10 years down the line, you are not being eroded by the effects of inflation. So your purchasing power on that income amount is not diminishing. It's important to try and keep pace with inflation so that your purchasing power remains the same. You don't want to find yourself in a situation where you haven't taken into account inflation and 10, 20, 30 years down the road, your income amount that was sufficient today is not enough to buy you a loaf of bread. So we're always taking into account that inflation scenario as well. That will jump around on current inflation numbers, but ultimately what you're looking for there is some kind of backdated average, A, or B, an amount that for you personally makes sense. I hope that's clear. Moving to the right-hand side, again, in this assumption, we assume that Joe's soap requires an annual income of R1 million. That annual income will kick in at retirement. So at age 65, remember they've got 20 years until they get there. So they're in a position to save and contribute to the portfolio and not withdraw from it. We assume annual contributions, again, in this scenario, of 240,000 Rand per annum. I mean, if this isn't clear, these are all thumb-suck values, but I think the importance here is just around what effects this has over a prolonged period of time with these assumptions. And then we assume Joe Soap has a current saving balance of 3 million. That current savings balance is important because that is the capital amount that is doing the heavy lifting or is assumed to be generating some kind of return. And I think, again, in terms of portfolio construction, when we do a lot of the initial analysis work, it's understanding whether or not the current assets are in a position to generate the return assumptions, right? So we could see return assumptions scaled up or dialed back depending on what that current balance sheet looks like. So again, in this scenario, we've got 3 million. Ignore the rest for now. I'll show you how this all plays out, essentially up until age 99 in the next slide. So jumping to the next slide, you'll see there's a couple of rows here, namely year, age, salary contribution, withdrawal, growth, balance, and return. So remember, we started with a capital amount of 3 million. You can see that in the top right. Joe Soap is age 45. You will notice that there is a contribution of 240,000. That contribution is also increasing each year by inflation. You will notice that there is no withdrawal. So in other words, Joe Soap is not retired. They don't need to draw capital down from the portfolio. So that withdrawal only kicks in at a future date. Again, an important characteristic there, because ultimately those 20 years leading up to retirement are the years in which you can compound and grow the portfolio up into a significant amount so that you can live off it, right? So you can draw the income down from it. The growth is the actual monetary amount each year of the return. And then we've got our return assumption on the right-hand side, that 10%. So you can see that after year one, our 3 million has a 10% return on it. So it's growing by 300,000 plus an additional contribution of 240,000 that we spoke about in our assumptions. That gives you a capital value at the end of year one of 3.5 million. And you can see very quickly after that the effects of compounding kicking in. Again, keep in mind, when we assume these kind of return assumptions, they're linear in the model, meaning that they grow on an annual basis by that exact amount. The reality of markets and investments, as we all know, are somewhat different to that. You'll have years where you do greater than that return assumption, and you'll have years where you do worse than that assumption. What we're looking for when we define our return assumptions is a long-term return that's viable. So let's say long-term equity markets are doing 10% in dollars. That becomes somewhat of a viable return if Joe Soap needs to target pure equity returns. We wouldn't go and put in there 20% because it makes the model look good. So it's important to keep some kind of realistic approach to that, and that's also fleshed out, like I said, by doing an in-depth balance sheet analysis and just understanding the current assets. Some assets won't keep pace with that. Others will generate higher returns or can potentially generate higher returns. Point being that it needs to be accurate, A, and B, it won't happen in a straight line. We're looking for that average over an extended period of time. All right, I'm going to jump to the next slide. The next slide is where it gets a little bit more interesting. As you'll notice on the left-hand side, Joe Soap has now turned 65. He's retired, and he starts to make withdrawals from his portfolio. Notice the withdrawal amount at just under 2.2 million. Originally, our assumption was that Joe Soap would take R1 million out in today's terms. That over 20 years, that R1 million has doubled. That R1 million has doubled and some. So again, that's as a result of the inflation assumption, and we do that again as a reminder, just to make sure that your purchasing power at time of retirement or at this future date is kept the same. So you can start to see there that the pressure as a result of the compounding from inflation becomes a lot higher. So again, important to have the assets in a position to be able to sustain those kind of drawdown levels going into the future. I put the balance here of 3 million just as a reminder of what it was 20 odd years ago. That's now growing to 40 million or 39 million. Again, just highlighting the benefits of time, A, and B, benefits of compounding over a prolonged period of time. In that 20-year window, you would have more than likely gone through multiple different market cycles, which I'll touch on the next slide. But again, you're looking for that average annualized return over a prolonged period of time to be in line with your earlier assumptions. You can then start to see the withdrawal and the effect that has on the capital balance. So you can see it increases to around 42.5 million at age 73 or year 29. And then you can see the effects of that increased drawdown starting to wear away at the capital base, ultimately reaching a point where if things were to play out identically to the assumptions here, Joe's Soap would be running out of money between age 91 and 92. The reality of these asset liability models is they're obviously not set in stone, but it becomes a fundamental driving point or fundamental thing to understand, so that when it comes to portfolio construction, you are positioning the portfolio in such a way that it can get as close to these assumptions as possible, right? Joe's Soap is not covered or not sustainable up until age 99, which means that one of the assumptions is too high or too low. Too high would be the income drawdown. So his portfolio is just actually not big enough to stomach that withdrawal. And too low would be the return assumptions. He needs to try and target a higher return because that will take some pressure off these numbers. So again, I'm not going into a return debate here around what's high and what's low and what's realistic and what's not. I'm more just trying to illustrate how the parameters have an impact. Now, I typically would try and position this differently. I would typically try and get sustainability much closer to 99. But again, this becomes a personal thing, and it becomes a personal kind of discussion around the likelihood of living to these later years, as well as if there are any dependents and things like that. So again, it's not a one size fits all. You might have something in the family that, I mean, no one's lived past 80 for argument's sake, and 92 would be considered well into the future. But I think you get the point around how this works, how the parameters are defined, and how it's still very tailored to each person's unique circumstances. Some people need much lower returns because their income drawdown relative to the size of their portfolio is small. Others require much higher. It all depends on what you're trying to achieve. Alrighty, moving on to the second pillar. It looks at one's risk tolerance. I make some notes here that it's largely driven by one's time horizon. We look at market cycles on average being between 5 to 7 years. And then we also note that personal goals here play a large role in determining the levels of risk one can take. So remember, when we say risk is largely driven by time horizon, it's because of these market cycles, right? So if you've got 10, 15, 20, 30 years until retirement, by definition, you can stomach volatility. So you can stomach the ups and downs of markets over that period of time, because you know that you will more than likely see different economic events throughout that time period. And should markets decrease significantly, take 2022 as an example, you can stomach that drawdown because you're not reliant on that capital in the near future, right? So you can wait for 2023, 2024 for markets to recover and go back into positive territory. So it's all got to do with your savings and your investments that you allocate to. There should be some kind of time horizon associated with it, so that you can understand the level of risk you can take. If you know that in 1 year from now, you want to use X amount of money to put a deposit on a house or buy a car or anything like that, you should not be going into high risk investments or investments that need a longer time horizon to pay out, i.e. equity markets, i.e. private equity, those kind of things, because you've got an imbalance there and it's going to lead to trouble. So that's really what we're talking about there. I show a chart of a typical business cycle and stock market cycle. You can see there you've got your expansions, you've got your recessions and your recoveries, and that is the typical kind of ebbs and flows of the markets. You don't want to find yourself in a position where if you need income in 2 years' time, you're investing 100% into equity markets, they experience a bear market, they drop down in value, and you're forced to pull an income from an asset that has decreased in value, right? That's kind of key here, is matching your time horizon to specific assets, and in turn using that to determine some kind of risk tolerance. Now, we are not fans of what we call risk modeling. Hence, we use the asset liability modeling. Risk modeling asks various questions around your perceived idea around how you view risk. So it asks you, do you mind volatility? Yes. Okay, well then you must only invest in income funds. It doesn't take into account any kind of future liability or time horizons or anything like that. So I think we definitely find that the asset liability model is a more powerful tool, because we allow the life that the client wants to live to drive the investment thesis and to drive the portfolio construction. All right. The chart on the bottom right, it's quite an obvious one, but I'll touch on it. Obviously, when you're looking at your risk versus return, you'll always typically find that the higher the risk, the higher the potential return, and the lower the risk, the lower the return. So it's just important to always keep that in the back of your mind. You can't kind of want to shoot the lights out, but take no risk with it. You're always going to typically find that positive correlation between risk and return. And it's an important thing to wrap your mind around when you kind of entering this journey of investment. All right, moving on to the asset allocation. So consider where we are in the process. We've looked at the asset liability model. We've started to get a bit of a compass or a roadmap and understand what one is trying to achieve. We have an idea around what kind of returns are needed in order to make those parameters a reality. And we start to get to the more nitty-gritty construction side of things and making sure that assets are aligned to those particular objectives or return parameters, right? So the one is very reliant on the other, right? So you can't really have a scenario in which you need a return of 8%, but you just want to sit in US Treasury bonds the rest of your life, right? Because there's going to be a mismatch at some point. And that's where the asset liability modeling is used to construct portfolios, because it tries to position, or tries to give the person constructing the portfolio a good idea of what they need to achieve, right? We look at that through the use of asset allocation. Like I just mentioned, this is largely driven by the parameters of the ALM. A client does not need to take any unnecessary risks if they only need a return of X%, right? A lower return. They shouldn't then be chasing high-flying, high-risk opportunities, because they're actually just putting their capital at risk for no real reason, right? They can afford to take a much lower risk profile and have much more security around that capital. The asset allocation is dependent on the time horizon of the investor. That was something that we looked at previously. You're not going to be going into high risk opportunities if you don't have the necessary time horizon to stomach the volatility that can come with it. And it can also be influenced by one's personal goals. Again, if you've got a near-term goal relative to a long-term goal, you're not going to be wanting to take as much risk on that near term as you would be comfortable taking on something that's longer term. So it's always important to have some kind of idea around the length of investment and what you're trying to achieve. To highlight this, I use three indexes here, or three different investments. I use them as a proxy almost to understand risk relative to return. The first one I use is the MSCI World. In this particular example, it is an exchange traded fund, and I use that again as a proxy for the global stock market, right? So this would represent a pure equity investment. I look to understand the return of that investment over the last 5 years on an annualized basis. This is all in US dollars, just by the way. That has a return of 12.21%. So that would be my again, I'm using the word proxy a lot, but that would be my proxy for global equity returns. That comes in at a standard deviation or risk of 17.95. So when you look at it relative to the others, which I'll dive into more detail now, you can immediately see that if we're using standard deviation as a measure of risk, that ranks high up on the risk scale, right? The next one, Bloomberg Global Aggregate, that is the global bond market. And again, I use that as a proxy for bonds. That has a return of negative 1.64. It doesn't really prove the point nicely, but unfortunately the bond market has been in disarray for a little bit, and the annualized returns over the last 5 years are slightly negative. But you can see that step down in risk profile when you're looking at the standard deviation. So that drops to a standard deviation of 7.8%. And you can see there that you're dialing back the return profile, but with it, you're dialing back the risk profile. So you're seeing that correlation between risk and return. The last one is again, it's a treasury bond ETF. It's very short dated. So it is essentially US cash. So it aligns to US interest rates annualized over the last 5 years. That comes in at 2.3%. More importantly, for the example, you can see that risk profile is almost zero, right? And the reason for that is because it is cash. So I'm just giving you an idea around risk relative to return, and how one would step that down or step it up as needed. On the right-hand side, just a picture there on different asset classes. We've got equity, fixed income, cash equivalents, and alternatives. So we've looked at here essentially equity, fixed income, and cash. Alternatives are a bit harder to model on these kind of views. Alternatives will typically house things like private equity and that kind of stuff. Because it's private in nature, the data to get on it is less easy to come by. But you would typically see that probably around pure equity type risk, maybe slightly higher, maybe slightly lower, depending on the actual investment and the operator. That always plays a large role in it. And you would typically see returns there or thereabout, again, depending on the different opportunity and the underlying asset class within alternatives. You could see some deviation on that, but it would definitely kind of push to the upper end of the scale. And again, it's all about understanding that relative to what you're trying to achieve when you're building or constructing the portfolio. That's crucial to understand in this whole process. Step number 4, we look at diversification. So we look to understand the diversifying holdings across different asset classes and sub-asset classes. Bottom left, I've got a graphic there that just looks at the main asset classes. Again, equities, bonds, alternatives, commodities, and cash equivalents. And then getting into a bit more of the specifics around the sub-asset classes. Obviously, multiple sub-asset classes. We deal with them quite a bit, or we did deal with them earlier in the commentary when we look at the sub-asset classes. But really, there's a lot to play with here when it comes to portfolio construction and making sure that one is exposed to the correct elements from a diversification point of view. We look at bonds, we look at alternatives. Like I said just now, you see your private equity and things like that starting to come into the foreground there. We look at commodities, and we look at cash and cash equivalents. So again, it's just important to understand your blend, your diversification, and your asset allocation, always relative to what you're trying to achieve, right? So again, if you need higher returns, it might not be the best play to diversify with something like bonds, right? Because you're just not going to get the numbers that you want. Alternatively, if you don't require a very high return, bonds might have the perfect place in your portfolio to help smooth volatility and generate a little bit of upside. So again, it's all about understanding the playing field and the parameters based off step 1, which is the asset liability model, and then translating that through into the portfolio construction. Second note there I add is the ability to add alpha, which is outperformance above a specific benchmark. So something higher, a return higher than the benchmark via manager selection and style allocation. So they're just highlighting the importance of making sure that sub-asset class box is ticked and diversified nicely, because you can get some outperformance from that. It can be quite an easy box to tick in the greater scheme of things is this diversification box. It's often considered in the investment world as the free lunch. So by diversifying, you can generate additional returns, or at least decrease your risk profile and still keep pace with the return that you're trying to achieve. And then lastly, I add a note there, just saying the use of active managers to shift between different styles of investing, which I'll talk about shortly. What I want to touch on now,
Anthony, sorry, mate. Yeah. Just considering we're part of the diversification mastermind, I'd love to just repeat what you just said there. Diversification is the free lunch in terms of investment terms. I just think it's quite important that I re-highlight, because often people hear important things, but they don't let it sink in. So just repeat what you said there again, and just give a little bit of essence to what you mean by that.
So some people often refer to diversification as the free lunch of investing. And most people say there's no free lunch in investing. So basically saying that by diversifying, it's something very easy to do, and one can do it very easily, and it can have a significant positive impact on one's portfolio simply by diversifying.
Awesome. Thanks, dude. Sorry for interrupting.
Cool, no stress. And I think I'll use that to kind of just talk to the chart on the right. I know a lot of people really enjoy this chart, but it really talks to diversification, and more specifically, it talks to the inclusion of alternatives or private equity as a sub-asset class under alternatives in one's portfolio. Starting on the bottom right of this chart, I don't know if you can see my cursor, but what we're looking at there is we're looking at a portfolio that's comprised of 30% bonds and 70% stocks, right? 0% private equity. The bottom axis of this chart looks at one's standard deviation / risk, and the left-hand side of the chart, y-axis, if I'm not mistaken, taking me back to varsity days here, looks at the annualized return. And at an allocation of 30% bonds, 70% stocks, you're pretty much at around 10.5% risk, but you're on the lowest return spectrum. So you're at around 8.5%. As we start to move up the chart, the inclusion to private equity grows, right? So you're starting to get to 5%, 10% private equity, 15, right up to 20% private equity. Now, at 20% private equity, you can see you actually decrease your risk or standard deviation. So that drops down to between 9 and 9.5, but your return profile has increased. So again, this talks to the free lunch around diversification and increasing your potential annualized return whilst decreasing risk. So that's an important thing to keep in mind. I would argue that you could, again, it's person specific, but we typically comfortable playing in that 20 to 30% private equity space. Again, depending on the underlying clients and the underlying opportunities, but one could probably extend that 20% to around 30%. The chart is a little bit outdated. Bond market, like I said, actually post this 2018, if you think about the previous chart, being 5 years annualized, has not been great. But again, the bond market becomes your ability to allocate to other things. In this example, you could increase your equity exposure, things like that. But again, going back to step one, that's driven by your asset liability model and what you're actually trying to achieve. There's no need taking undue risk if you don't need to. It just doesn't make sense unless you need to, or you're trying to achieve something that requires you to do that. So again, using step one as the roadmap or the compass to this portfolio construction part of the equation. In the next slide, I just look at ways here of again, potentially ways to generate a free lunch, potentially ways to generate some outperformance, ways to use active managers to rotate between the different styles or sub-asset classes. This is not a debate around active managers versus passive exchange traded funds. It's merely to show a point. For those that have dealt with me in the past, you'll know that we actually have a very agnostic approach towards active and passive managers, and we believe that each one has a role to play within a portfolio. So I don't want to get into that debate now. I just want to show that in our first example, we look at a random active manager relative to its benchmark, which is the S&P 500, which happens to be one of the biggest indexes in the world. And we just understand that what role manager selection can play, right? So you essentially have the active manager in the first column generating a return annualized in US dollars over the last 5 years of 17.3. The benchmark S&P 500 generating a return of 15.23. So you can see there that there is some outperformance just looking at return. If I move to the next block, which is probably a more interesting one for me, it looks at the standard deviation, which, as we discussed previously, is just one of the many measures for risk. And it shows that over that same period of time, the active manager taking on slightly lower levels of risk relative to the index. The third block is looks at alpha. Alpha is another word for outperformance. It numerically aims to understand what that outperformance looks like relative to risk. And as we can see, this person is doing a higher return at lower levels of risk. So he's rewarded with a positive alpha number there of around 4. And then I show relative return as well as correlation. Relative return for this example is not overly important. Correlation looks at how close the holdings or the movements are relative to the particular index. So you can see that it is quite high, it is quite close, but there's been some key decisions along this 5-year journey that have resulted in outperformance at lower levels of risk. So again, just highlighting the ability to use instruments here within the portfolio construction that can also increase return and decrease risk. So similar to the chart we looked at before with private equity as an example, this just shows how one can do it in the listed market space as well. Again, not trying to say which one is better. We typically use both in portfolios, but important to understand the role that they play. Even if you're just using an active manager, not necessarily to outperform, you're looking at outperformance as a bonus, but rather to protect on the downside through those lower levels of risk. So if you can save a few percent when markets move down, that's also viewed as outperformance, right? Because you're not going all the way down the same way another holding would. And then again, just looking at another example at the bottom, instead here, I look at a manager who uses the MSCI World as their benchmark. So a bit more global approach compared to a US-centric benchmark like the S&P 500. And again, these kind of opportunities exist where you've got guys historically generating higher returns at lower levels of risk. We can see that once again with a strong alpha. Okay, moving on. In this section, you will notice the inclusion there at the bottom of what Scott affectionately refers to as the bucket approach, which I'll touch on shortly. But really, number 5 looks at the individual client or person's personal outcome and goals. Here it's important, like I said earlier, to establish or determine what this particular pool of capital is trying to achieve, right? If it's a short-term goal, if it's a long-term goal, they're going to have different characteristics to it. You're going to invest that money slightly differently using the process previously discussed. So again, very important to understand what that outcome is or what you're trying to achieve. Again, any defined outcomes other than retirement, defined being the key word there. I want to buy a car in 3, 5, 7 years, or a house, or a yacht, or a jet, whatever that might look like for you. It's important to understand that or make someone aware of that when you're entering into these planning stages, because there is different ways to treat that. The most popular one is the last one. Again, this is personal scenario dependent. It's not for everyone. It is for a large amount of people, but it's not for everyone. This looks at retirees and the bucket approach. So in a nutshell, we break this down into 3 buckets or portfolios or baskets, whatever you want to call it. And those three buckets are the income bucket, the essential capital bucket, and the growth bucket. Now, these are already broken down into time horizons, right? So we had quite a bit of discussions about this last time, but I try and give those time horizons there. Income bucket targets 3 to 5 years, essential capital bucket targets 5 to 7 years, and the growth bucket targets 7 years plus. Now, for retirees, the asset liability model process looks a little bit different, right? And for people who have used the earlier version and have built up to retirement, when retirement kicks in, things typically change, right? And they move into this bucket approach. And what the bucket approach tries to achieve is that it knows that you're going to require an income from the portfolio, right? And the goal of it is to separate different pools of capital for different outcomes or goals or objectives or whatever you want to call it. But ultimately, that income bucket of 3 to 5 years is there to provide you with income for that time period, right? It is typically invested into things that are less volatile, that are less risky, and with it generate a slightly lower return, right? So you want to, in other words, protect that capital at all costs, right? Because that is your pool of capital for the next 5 years where you're going to be drawing an income from. You don't want to wake up one morning and markets have fallen out of bed, and all of a sudden you're forced to draw income off a capital balance that has greatly reduced in capital, right? Because the long-term effects of that, depending on the drawdown, can be catastrophic, right? You're decreasing the capital amount, and in the future, when the market recovers, your recovery is off a much lower capital base. So your monetary return on that capital is significantly reduced, right? So that would be a worst case scenario. So you want to ensure that that capital is safe, and it's protected by being in the correct investments for that particular bucket. When we move to the essential capital bucket, we have a time horizon there of roughly 5 to 7 years. The reason why we do that is because it correlates quite closely with the average market cycle. And it means that if we've got our income bucket protected for 5 years, we know that the rest of the portfolio, we can increase the risk profile a little bit, right? Because we understand that with income taken care of, you have the ability to stomach increased volatility in your essential capital bucket, meaning that you can target slightly higher returns because you can have more risk on that portfolio. So it's important to understand how the role that they each play. In that essential capital bucket, let's just use it loosely here. In the income bucket, you would be targeting things like income funds, investments that have allocation to cash, as well as a little bit of bonds, maybe pref shares in property. Those kind of relatively low risk investments that are going to generate a decent return for the amount of risk that you take. When you move into the essential capital bucket, you can increase that risk profile. Maybe you might look at the inclusion there of some equity. Historically, we know that equities generate the highest return, but they also are the most volatile. So we can look to include some equities there to bump up the return profile in that essential capital bucket. Lastly, in the growth bucket, this is a portion of capital that's set aside for 7 years and longer. It's our high risk, it's our high growth, it's our high return bucket. Typically, you'll find things like private equity with the longer term time horizons in this bucket. You'll find things like equity funds, that kind of stuff. That will all find its way into the growth bucket, because we know that with our other two buckets ticked, we don't need to be reliant on that bucket for that 7 years and longer time period. It can be invested, and it can go through its whole investment life cycle without us having to worry about drawing down any kind of income from it. So whether it goes up or down throughout that 7-year period, or whilst it goes up and down through that 7-year cycle, one doesn't need to wake up and stress about losing money or drawing down from a lower capital base. What happens post these time horizons is somewhat of a waterfall effect. Once your income bucket is depleted, The idea is that your essential capital portfolio would have moved through its investment cycle, and profits can be trimmed from that essential capital bucket and topped up into the income bucket. That would then essentially start the next cycle. When growth assets start to mature at the end of their life cycle, profits are then trimmed from that and allocated to the essential capital bucket. And then that as I'm sure you can understand, that kind of kicks off the process or the cycle again. And you've got this continuous waterfall effect where you're constantly taking care of from an income point of view, and you're positioning your assets in the right categories, so you're giving them the highest likelihood of success. The worst thing that you can do is kind of interrupt a particular asset's life cycle and make rash decisions, and start to chop and change or pull money out when it hasn't kind of worked through its full life cycle. All right, I'm hoping that makes sense. In terms of the asset liability model, when you plan for something like this, your parameters change in that you will be making different assumptions on the different pools of capital, and you will be basing the size of the pool of capital off your income drawdown. So income is always going to be the key kind of driver of this whole process, and therefore the size of your portfolio and the size of the bucket will vary based off your personal situation, right? And then we assign different return assumptions based off the different buckets and based off the portfolio construction strategy for each different bucket. All right. Moving forward onto the last.
Anthony, just before you go, did you see Mike's question about the 3 buckets?
I didn't know.
I'll read it to you quickly. He said, in which of the 3 buckets would a retired person place Scott's property deals? E.g., a data center in Asia, a commercial property in the US that already has a tenant paying, a mixed use in Germany.
Yeah, good question. I don't know all of those deals off the top of my head. I'm assuming their time horizon is probably north of 7 years or thereabout. And because of that, they would go into the growth bucket. Again, it's private equity in general is somewhat of an illiquid asset class. So you're not going to place it in your income bucket knowing that the income or interest payments are not sufficient to match your monthly or annual income requirement, because you're not going to be able to draw capital down if you need to. So because of that, it starts to push out the time horizon, and it's better suited to something like essential capital or growth. If that time horizon was more in the 5 to 7 year space, relatively low risk investment, good interest or income characteristics associated to it, then maybe it would fall more in the essential capital bucket. But importantly, it's understanding the nature of the underlying asset and its time horizon to group it in the right place.
Let's just while we're on this, let's just because I think it's actually a great question. So like if we take ABF, the Austin Business Finance, 3-year investment, income producing deal, or the Manhattan deal where it was a debt deal, 18 months, purely income, where would you put those?
The ABF loan and Manhattan would more than likely form part of the income portfolio. Again, personal circumstances around whether or not that interest rate is covering the full income requirements or not. Maybe they're used as a supplement to something else that can be leaned on for additional drawdown. But typically they would form part of that bucket. I think the next one that you mentioned was the German property deal. That, if I'm not mistaken, has a time to maturity of between 5 and 7 years, probably on the lower side of that. So you would be grouping that in the essential capital bucket. Another key differentiator there between the two is one is debt that pays an interest rate. The other is equity that one can expect some kind of equity return or equity upside to it. So equity, when there's that compoundability, it starts to creep its way into the essential capital portfolio. Again, whether there's a supplement there around the income side of it going into the income bucket or the income portion of that particular deal is again on a personal circumstance base, or whether that income is used to reinvest into something else is also debatable, again on personal circumstances.
Perfect. Thank you.
Cool. Okay, moving on to the last slide. Fairly straightforward, fairly self-explanatory. Just looks at the monitoring, measuring, and rebalancing. Obviously important here to kick the tires, make sure that performance is being monitored relative to benchmarks on a quarterly and annual basis. Quarterly is probably a bit premature. Again, it's something that you want to keep an eye on, but you don't want to be looking at it all the time, right? Markets move up, markets move down. Things like private equity remain relatively static in their pricing for a prolonged period of time. So you don't need to look at it from an ALM point of view. You don't need to look at it too frequently. But obviously just important to make sure that you've got a grip on everything. If there are any steam trains heading for you, the ability to rebalance and reposition ahead of that is obviously always a great idea, and you can only do that if you've got a handle on what's going on. Secondly, monitoring performance relative to the financial plan and ALM. Like I just said, this can be done at longer intervals due to market cycles. You might have a year like 2022 where markets are down. It's really not going to help reevaluating these things on a monthly basis. It's much better to do it now once you've seen the recovery play out, and just make sure that on an annualized basis, one is kind of there or thereabout where they need to be. If there are any changes to circumstances, it's important to identify those and readjust the ALM parameters and remodel this. Let's say you intend on retiring earlier, or you intend on giving one of your grandkids some money or anything like that, any kind of parameters that can affect the ALM. It's important just to make note of them and adjust or change things if need be, because they can have a material impact on the way things look going forward. Lastly, rebalance the portfolio if there have been any significant changes in the parameters, or if specific targets have been met, reallocate to investments that offer greater upside potential. So again, if a pool of capital has been removed for a property purchase, but it actually did better than expected, and there's some left over, reallocate something like that. If there's need to move between sectors or sub-asset classes or things like that, then that obviously must also be done. But I think, like I said, this is pretty straightforward and self-explanatory. And that is it, Scott.
Scott, I don't think I can hear you. I don't know about anybody else.
Can you hear me now? Sorry.
Yeah, I can. It's quiet though.
Yeah, should be fine now. It was a little
Yeah,
bit
it's good.
switched off.
Good.
Went to sleep. Okay, right. Give me some comments. What did you think? It's pretty awesome when you get to learn from what the top 1% are doing in terms of all that approach. I just want to take some of the comments that were said here. You know, Kevin, I loved your, I think it was Justin. I loved your comment around your age. I also spoke about the Enneagram wealth and how this is about all building it around your lifestyle that you want. And that's why portfolio construction is so important. Whereas where Justin said his age, where he's 23. So yeah, very, very useful in terms of, you know, what you need to know and everything. And like I said to you, that's only been shared before with our mastermind members. So it's pretty interesting in terms of, you know, getting access to that information. Okay. So what I want to do now is I want to pivot you through, and I want to take you through some things quickly. Do me a favor, type in the chat box what you thought of that and whether it was worth me sharing that for you. So I want to come back to this here. And okay, when you share, am I sharing my screen? Are you getting access to the screen? Nope. Okay. Right. So you can see there that Derek said, thanks, very valuable. Kerry, loved that, very insightful. Sylvia, amazing, very valuable. Complete mind shift. That's really valuable. Lots of useful information. I wish I knew the bucket approach when I received my pension. This is interesting and very valuable. Anyway, I think you get the point in terms of this whole thing, thought-provoking. So let's go back to the 3 reasons people don't get results. Okay, the first one is I don't have money. So they use the excuse that they don't have money. The second one is that they say I don't have the knowledge. Okay, and the third is that they say they don't have the time. So this is one that I find really interesting, because what I really find interesting here is that you can go out and you can kind of get the time. You can kind of do it all yourself, and you can literally go and try and figure it all out yourself, or you can literally go and copy from others and how it is. And there's a short little video that I want to play here for you. And this one is from Niels. So Niels and Catherine are part of our mastermind, but they've basically spent their time. They've gone out, they've done their different investments. They've spoken to different people from all around the world around the different financial advisors in terms of trying to get them set up and this and that. And what was so interesting is that in a very short amount of time, they were able to get results. And the reason being is that you are working with people that have already done it before. So hopefully you've seen now, what are the top 1% doing? They can sit down, they can help consolidate the entire approach in terms of what we're looking at. And this is a short little video. There's a longer version if you want it, but I'm conscious of people's time. So I'm just going to play you the short version here of what Niels and his wife experienced and what it meant to them.
No, definitely, Scott. I mean, it is so stressful not to know where to go. To have financial partners and advice. I mean, just the connections that you gave us, bring us in contact with these people to understand it. It makes a world of a difference. It takes a lot of stress off your shoulders, weight. It's actually a very positive experience, especially in the world now with all these uncertainties. But from a human side, I mean, this was a phenomenal experience. And it happened so fast for us. But we were ready for it. I feel that we have proper partners in you and in the mastermind and with Calio. It's a very positive experience.
I mean, for those of you that are time poor and want to be able to get results, then again, you can go learn all the stuff yourself, or you can partner, and you can actually have, like I've said to you before, you can literally have someone hold your hand and walk this journey with you in terms of this process. So this is the formula. You diversify across countries, currencies, assets, partners, and time. But the third thing that I wanted to share with you, so I shared with you 2 personal stories already. One was get what you want, and how to do it. And if you remember, I told you the story of going to Tony Robbins. And the second story was get the knowledge. And you can do it through partnership. And I've showed you already how you can do it through partnership. You can copy the top 1%. You can model what they're doing. Even if you join the Wealth Hackers, you're getting the tools and everything else and the knowledge. And then finally, the last one is get the time that you want. And this is a personal story for me, but it was in 2011. And I told you already, I was working too hard, and we're now building a good business. And I met Roger Hamilton, and I got invited to speak on stage with him. So this was me and him presenting on stage in 2011. And he said, Scott, you should really join my mastermind. And I was like, Roger, I'd love to, but I don't have time. And he said, well, that's interesting, because the very thing that's stopping you from the thing you want, which is time, I can teach you in the mastermind. And so I was like, okay, well, explain this to me. I'll never forget, it cost $12,000 to sign up. I paid $12,000. I was part of it for 10 years. I ended up paying up to like $25,000 to be part of that mastermind per year. But what was so interesting is that, he said to me, like, come along. And so my barrier to entry was time. I said, I don't have time. Now, how many of you, if you're honest with yourself, you're an entrepreneur, you're a business owner, you're probably not even here because you don't have time, or you're a busy professional, you don't have time. And what was so interesting is that he helped me put the right people into the company. He helped me bring the right systems into the company. And 4 years later, actually, I had the privilege of going to Necker Island. Richard Branson invited me through Roger Hamilton to Necker Island. And I got to spend an incredible week on Necker Island while the business still ran. And so the very thing that I didn't have, time, Roger, by investing in Roger and the mastermind, I got back time. And it's really an interesting thing for me because when it comes to wealth, so many people say, well, I want to be wealthy. And I go, cool. Or I want to make sure that I'm okay for my retirement, or I want my money to work for me. And what was so interesting, then I say, cool, why don't you join the mastermind? And then I go, how much time is it going to take? And I say, 3 hours a month. And they say, I don't have 3 hours a month. And I'm like, are you serious? Like, I guarantee you that in 10 years, whatever you want in life, whatever it is, if you want to be healthy, wealthy, you name it, love life, I don't care what it is. If you do not invest 3 hours a month in that process, it will not happen, guaranteed. And so, that's my kind of story when it comes to time, is that, you actually have to invest time to get what you want, but you can do it in a lot more condensed time. So you can come along, you can work with the principals of the family office, just like Niels and them, and you can condense time. So you don't have to take a lot of time, but you do have to invest time to be able to get results. And so I want to share with you, because some people have asked me, what is the mastermind? What is it all about? And I want to share with you what it is about. So something that I love is this little picture. And, the question I have for you is, if you're in a comfort zone and you want to get out of your comfort zone, well, it's scary to get out of your comfort zone. I have this all the time in my one-to-one coaching. And like, people are like, oh, it's scary to get out of my comfort zone. I want to kind of stick with what I got. It's easier to complain and blame and all that other stuff. But ultimately, it's when you get out of your comfort zone where the magic happens. And what's interesting is that people are 5 times more committed to their plan than they are to my plan. And so we work a lot with the psychology, because at the end of the day, everyone wants results. Every single person who's here, if you're still here, it's because you want results. But the bottom line is, there's the emotions, the values, the thinking, the assumptions, the bias, everything that's happening below the iceberg. And 95% of people are stuck in this away state. They're withdrawn, they're fearful, their inability to make good choices, they're demotivated, etc. And the question is, how do you get in a toward state? How do you get to be happy, ability to think clearly, creative, see new opportunities? And I always say this to my coaching clients, my mastermind clients. There's only 2 ways. The one is you get in a like-minded group of people. So you need to be in a like-minded group that are all going in the same direction. And the second is that you have to get clear on your outcomes. So again, most people are really busy and they're kind of drifting around the world, but what are your outcomes? So when I sit with you one-on-one, I don't get caught up in your problems and drama. I'm not interested. I'm interested. We call it the lighthouse approach. What are your outcomes? What are the top 3 outcomes that you want to achieve? What are the top 3 priorities that you want to achieve in the next 12 months? And what are the top 3 measures that we can determine whether you're successful or not? And it's so important, because when you get clear on your outcomes and you get in a like-minded group of people, that's when you get in a toward state. Watch this little video, which will just explain it for you here. Just want to make sure that the audio is on properly. Yep, it is. So watch this little video. It's a very powerful video I found on the power of being in a like-minded group of people. Come on.
No, this is extremely predictable. There's tons of research around it. Humans change 5 times faster in groups than they do with a one-on-one coach, consultant, or therapist in that case.
Wow.
So I started looking back at business models and people who had done this effectively over the generations. Masterminds aren't new, folks. They're not new at all. People have been doing this for thousands of years. And when you put a collection of people together who are all committed, all driven, and all so want to make the right changes happen, and you give them a leader to follow who's willing to get in the trenches with them, all of a sudden you start finding real, rapid life or business transformation.
So what's interesting, if you look at that quote, in terms of what he's just said, he said, humans change 5 times faster than they do with a one-on-one coach. You need a collection of people who are all committed, all driven, and also want to make the right changes happen, and give them a leader to follow who's willing to get in the trenches with them. And all of a sudden, you start finding real, rapid life and business transformation. I just want to check, can you guys see the screen? Are you seeing the screen with the yellows? Yeah. Cool. Okay. So that's why we created the mastermind. We started it in September, October of, we launched it in September, and we had our first session in October of 2023. We call it Private Wealth Global, which is all about getting results safely and simply. And it's a enhanced partnership between our family office and between Wealth Migrate. You know, what's interesting is that the focus is globally diversified passive income and portfolio growth. And again, how do we do it? You know the formula now. We diversify between countries, currencies, assets, partners, and time. And we set people up. So we literally go through the process. We get clear on your outcomes. We break it down into midterm planning, and then we got your tasks and activities. Now, we work with the family office, and I've done work with them since 2012. And what was interesting is that across their 65 families, we went and looked and mapped and tracked what do they do with their 65 families. And there were 9 steps. And these 9 steps are how they set their families up for generational wealth. This is not only how they optimize what they currently have. This is what they do to protect what they currently have. They set up the right tax and structures. They make sure that they are growing the portfolio. They make sure that they are leaving a legacy and that they can hand it over to their children and ideally their children's children. And there are 9 steps. And I know that we are long on time here today. Wednesday is always the longest session. But do you want me to run through these 9 steps quickly for you? I mean, I would strongly recommend that you screenshot this page. And whenever you go and see your financial planner, you should literally sit with your financial planner and say, are you doing all of these 9 steps? Because traditionally, your financial planner is only doing one of these 9 steps. They're helping you with investment solutions. That's all they're doing in terms of this process. So type in the chat box for me if you want me to go into the detail. I don't have to. I know them. So I can, and I can kind of pivot, or do you want me to go into the 9 steps quickly? Yes or no? Okay, so Jan said yes. I'll do it for Jan. Everyone else can duck. No, I'm joking. Guy said yes. Sylvia said yes. Justin said yes. Okay, I'm going to run through it really quickly. I can go through it at another time if people want to go into more detail. So you'll basically see, if I go back to it here, that there are 3 phases. You've got the setup phase, you've got the planning phase, and then you've got the results phase. So the first phase is setup. So again, I'm going to go through this very quickly. It's about establishing your vision. So you and I sit down and we get very clear on what are the outcomes that you're wanting to achieve. And we literally write down, what are your top 3 outcomes? What are your top 3 priorities? And what are your top 3 measures in terms of the process? This is what one lady sent me as a voice note based on her experience of going through this process. Let's see if it plays.
Hi, Scott. This is just a quick fan message. I just wanted to thank you again for our coaching call the other day. And then also wanted to thank you for the brilliant idea of that, sort of publicly putting in your goals in that Google Sheet. I see that the Google Sheet magically populated itself since the first time I saw it. And I must say the 2024 goals are very inspiring. And yeah, it's amazing to see. I found it incredibly supportive to see, people's just the amount of energy and the goals, and yeah, it's really inspiring. So just wanted to thank you for that. I really enjoyed reading everybody's goals. I haven't read all of them, but and somehow it's just really helpful. All right, well, have a fantastic day, and we'll see you in February. Bye.
So, the first step is all about simplicity. I fundamentally believe that simplicity is power. And the more clear you get, the more you've got of actually turning something into a reality. The second step is all about the investment solutions. This is about setting you up. So you actually get access to our Private Wealth Global, which is where we have private deals. We work exclusively with Callio private equity team in terms of that process. And everything that is involved with that process. There's also a 50% discount on the fees. The third step is the investor profile. So this is all about the Enneagram and wealth. And again, I don't have time today, but there are 9 different profiles. It's the oldest profiling system in the world. And what the team that has done with the family office is married together so that as an investor, you've got the Enneagram and wealth. And then that actually helps you know what you should invest in, what type of investments make sense for you. and you actually get an investor report, which literally takes you through yourself. There's 27 different tri-types. It's not about putting you in a box. It's about you understanding yourself better, making far better decisions so that ultimately you can make better choices and you know what the right type of investments are to invest in. So the Enneagram and wealth is literally all about giving your people clarity and insights in terms of that overall process. Then we literally pivot through in terms of to phase 2, which is the planning. And this is where you sit down with the family office, do a portfolio health check. It's literally like doing a health check, like when you go see a doctor, a health check. So they look at what you have. They look at your tax. They look at your structuring. They look at your property portfolio, your pensions and your investments, whatever you have. It's about looking at what you actually have in terms of the process. I can see my computer's playing games here. Okay, it seems that we are stuck on portfolio health check. Give me 2 seconds. Okay, I'm just going to open that up again. For some reason, it's frozen. Okay, let's open up day 3. Why is it playing games today? Gotta love technology. At least you know I'm live. Okay, where were we? We were on portfolio health check. So what I was basically trying to show you here is this is where you go through the family office. They literally go through your portfolio, your properties, and it's all about understanding who you are and where your entire portfolio is without overwhelm and anxiety so that they can help you optimize your portfolio. And, it's all about, again, like Neil said, you've got advisors all over the place. And now it's so nice to have it all in one place and also to have a holistic view globally as to what you should or shouldn't be doing. Then the next one is the most important one, portfolio optimization. This is where they now take your individual circumstances. You just heard from Anthony about how they do that, your Enneagram profile, and your asset liability model, which you've just seen an exercise on how to do that. And they help you build your portfolio. And this is where every single person gets their own tailor-made solution. So again, if you want your own tailor-made solution, apply to be part of the mastermind because, if you want to be part of the mastermind, just type in the word mastermind. And if you qualify, you will get access to the family office. So they can literally go through this process for you in terms of everything that we do. The 6th step is wealth, lifestyle, and legacy plan. And again, we've got 2 partners here, both David and Amy. And this is where we actually take you through a full procedure in terms of setting you up generational wealth. Amy can actually come in and facilitate a process where you sit down with your family, you understand the language of investing. There's a test where you can, as a family, you can fill it in. And then most importantly, it sets you up with a roadmap going forward around the conversation, around money. It's not, just handing over money is one thing, but how do you actually educate people? How do you empower them? And that whole conversation around wealth and investing, et cetera, et cetera. So that's step 6, the wealth, the lifestyle, and the legacy plan. Then we go to results. Now, this is, how many of you in life have had a plan but not actually executed on the plan? So the first one is accountability, mindset, and execution. And this is where, again, you want results, you've got all the stuff below the iceberg. However, we want you to be in a towards state. So we start off with that outcome, like I said to you right at the beginning. But now it's about the midterm planning. Now it's about checking in every single month. Now, I learned this again from Roger Hamilton, where every month you're checking in. And you'll be amazed because you blink, like, I want diversified passive income. And you blink and another year's gone past and you haven't done it. But actually, if you're checking in every month, then you can truly make it a reality. So, we've got this, which is a monthly accountability sheet. And you basically got your top 3 outcomes, your top 3 priorities, your top 3 measures. And then every month you're checking in. Did you do it in green? Are you doing it orange, red, not done? So that every month you're checking in to be able to get that process. For some people, before I go there, 99% of individuals said if they had a coach, they reported them helpful, 95% reporting that it was very helpful, and 96% reported they'd be engaging in coaching again. So what I found is that a number of people didn't want to do the group coaching. They actually want to do one-to-one coaching with me. So I actually have a more advanced tool for the one-to-one coaching where I sit down with someone. They've got an hour a month with me. We literally work through what do they need to know, how are they going to move it, and everything in terms of that process. And as Angie said, in terms of this, thanks again for the session. I always leave feeling energized, motivated, and feeling good about what I've accomplished. So it's about helping people move in a measurable way every single month to be able to get results. And then you've got the daily activities. And again, most people battle with habits. So I take people through a process to help them get their habits in the right place. And time management comes up 9 times out of 10. How do you help someone create the life that they want, have the time that they want to do the things that they want in terms of that process? So accountability, mindset, and execution is all about getting results. Step 8 is community partners and knowledge transfer. And this is where we've got an exclusive learning community platform, calendars and events, accountability, community engagement, etc. So, I mean, if you go here and I just show you something I'm super proud of, when you go down here, you've literally got the 9 steps. So you've got a setup and then you've got the 9 steps. Step 1, step 2, step 3. That's the setup, the planning. Step 4, step 5, step 6, the planning, and then you got the results, accountability, community, etc. And so this is the process that we run through to take everyone through in a systematic approach. They've got access to the classroom, the community, the calendar with everything, etc., all in one place. So this is the process that we've set up to set our mastermind members up for success. And then every month we have a session. It only is half an hour where we sit with Anthony from the family office. He takes us through the market. I've already mentioned it today. So just imagine you met Anthony. Now you're going through it with him on a monthly basis. What do I need to know about the global markets? You talk about condensing time. Rather than spending hours listening to podcasts and reading stuff and whatever, rather turn up half an hour and find out what is important that you need to know for the last month. Then it's all takes into account your portfolio construction. There's always a learning lesson every month where I teach you something important around the financial understanding. We're obviously looking at investments and we're reviewing them in terms of being able to look at investments. And people consistently say, the value that they get out of this process. And then the last part, which is investments and results. Through quality investments and partners, we enable our members to achieve results in globally diversified passive income and portfolio growth. And as Cynthia says, thank God for this mastermind, the partners it brings us, and the exponential learning curve that it has gifted us. If you're interested, we've got 3 different levels. We've got the 6K Club, which is for retail people that want to become sophisticated investors, and it's all about mastering your portfolio. We got the 12K Club, which is for high net worths that want to become global investors, and it's all about global diversification. And we got the 24K Club, which is about generational wealth investors, and it's about ensuring your legacy. And one of the things that I'm proudest of is that as a community, we get together. So in March 24, we got together in Stellenbosch in Cape Town, South Africa. In August, we did the Cradle of Humankind, which is the oldest existence of humankind around the world. An incredible exercise. We did a buyer's trip in London to go to London, and actually that was us at the top of that penthouse buying buildings in London. And this was us in March this year in Knysna, South Africa. We had an incredible experience there too. So if you get to join us, you automatically get access to the wealth hackers and everything else that we've discussed already today. You also get access to immigration agents if that's something of interest to you. You get access to buyer's trips. You get a 20% discount. And if it is of interest to you, then just go to the link, diversificationmastermind.com, and apply. It's not for everybody. I fully understand that. And so what we do is that we sit with you one-to-one. So we want to understand where you're at, what are you trying to achieve, and we want to make sure we can help you. The commitment that I made to Garth from the family office is that we would sit with everyone one-to-one. We would make sure that we understood what they're trying to achieve. It's not about money, by the way. So sometimes people sit down, they say, I don't think I'm a high net worth, or I don't think I've got enough money. That's not the truth. What we're looking for is a fit, energetically from a fit perspective. And there's a number of things that we look for which are important. And just like when I did Tony Robbins, the most important thing for us as part of the mastermind is to make sure that we're getting like-minded people and that there's a proper fit in terms of that. So my strong recommendation, if you are interested, I know that Sylvia and Brahm, etc., then just go and literally, book a call, or if you've already chatted with Alex just send Alex a message and he'll be able to assist you in terms of that process. We do actually guarantee results. So this is something that's interesting, because in the financial industry, you can't guarantee results. And I can't guarantee that you'll get results unless you do the work. So why we say we guarantee results, as long as someone actually follows the process and goes through the steps, then we will work with them until they've got their results. Okay, so that's our commitment. But it's just like being in love. You can't say like we can guarantee it's going to work, because you've got to make sure that it's coming from both partners. So we guarantee we'll come to our side of the fence, but obviously someone has to come from their side of the fence. I got asked with a return on investment, and people who say, but how much money do you need? I had a gentleman that had $12,000. So if you got $12,000, or if you want to invest $1,000 a month, and you were to invest $6,000 in yourself, like, would it be worth it? What's the return on investment? Well, after 5 years, it's 182% investment. You would get out in today's money $10,900. Now, would you invest $6,000 in yourself to get back $11,000 today? If you could go to like a little money machine. What about over 10 years? It's 800% and it's $48,000. So would you invest $6,000 in yourself if over the next 10 years, it put nearly $50,000 in your bank account? Or what about over 30 years, which is the way you should be thinking if you take into account family, and it's a 12,000% ROI, and it's nearly $750,000, $743 to be exact. Would you invest $6,000 in yourself if it represented nearly $750,000 over the next 30 years? Yes or no? And if you would, then I'd suggest you go to this link, Diversification Mastermind, and sit down with one of the team. I love to show you these pictures because this is how we used to do it 10, 15 years ago. If you wanted to do this, the mastermind was a physical mastermind. You got in an airplane. This was us in New York, buying property in New York. This was us in Times Square. This was me with Dr. Dolph DeRuis, buying property on the steps of the auction houses in Phoenix. This was us having some fun in the Grand Canyon, and flying into the Grand Canyon and going to see a show in Vegas, and buying houses in Atlanta and more houses in Atlanta. Funny enough, that's Michael. You met him on day one. This was one of the houses he bought. This is a young guy, Ricky. He came on a buyer's trip when he was 22. And by the age of 30, it facilitated over $1 billion worth of multifamily. Really impressive story in terms of what's happened. In the old days, you had to fly overseas and open bank accounts in terms of that whole process. Nowadays, you can skip all of that. You can literally go to diversificationmastermind.com and you can literally get access to all of the different partners. You don't have to fly anywhere. It's literally all at your fingertips, no matter where you live in the world. But this is how we had to do it 10 to 15 years ago. And what our Diversification Mastermind is a replication of what we've done over the last 20 years. We know what works. Getting high net worths together, meeting with partners, getting access to the right information, the right partners, getting access to the right deals, diversifying. That's how you get paid. That's what works in terms of the process. This was outside New York, up in North Dakota, having some fun at Halloween. And these were three of the wealthiest gentlemen in Africa. They own the biggest privately owned shopping center group in Africa. And they were there. They knew that they shouldn't do anything on their own. They came over on a buyer's trip to learn and do it just like everyone else in terms of that process. Why believe we should work with you? Well, again, these are all the reasons that people use, but I've already been through this today. I don't have the time, I don't have the money, or I don't have the knowledge. Well, I've shown you how you can do this. I mean, previously you needed to have tens of $millions to get access to a family office. Now we've completely democratized that so that you too can get access. I don't have the knowledge. Well, I've shown you through both the Wealth Hackers and the Mastermind how you can get access to the knowledge. And specifically with the time, for the people that want to join the Mastermind, I've shown you how you can condense time just like Neil's so that you can get results quickly, simply, and safely. So 3 ways to get results. Get what you want, get the knowledge through partnership, and get the time that you want. There's another reason I think you should join us. We are the only platform that I know of in the world where it's about diversification, where you can invest in England, America, Australia, New Zealand, Europe, You can invest across different asset classes. You're not stuck. Like everyone else helps you do medical buildings in America or structured notes or, the stock market or whatever. Whereas we truly help you diversify. And I wouldn't tell you to do anything that I don't do myself. I spend $14,000 a year to be part of Singularity University. I spend $25,000 a year for 10 years to be part of Roger Hamilton's Crystal Circle. I spend $40,000 to spend a week with Richard Branson on Necker Island. I spend $50,000 to spend a week in Fiji with Tony Robbins. And what I've learned is when I invest in myself, that's when I get material progress. That's when I move forward the fastest and I get there quickly, simply, and safely. I'm sure if you've been successful, you know what I'm talking about. And this is why I feel so strongly in people investing in themselves to be able to get results. I've given you the formula. You can literally copy it. I've shown you the mastermind around how you can do it safely and simply and actually have someone hold your hand. And like I said to you, we call it a collaboration between our family office and ourselves. It's all about getting results safely and simply. There's 9 steps. Screenshot this. If you don't want to work with us, no problem. Screenshot this, go along to your financial planner, make sure they're implementing it. Because if they're not, these are the 9 steps that the wealthiest people are doing. And I remind you of the bonuses. You get access to the wealth hackers, you get access to the immigration agents, you get the wealth weekends, access to the wealth weekends, and you get access to the buyer's trips. So if you want to apply, it's really easy. Just go to diversificationmastermind.com. I know that Kelly's kindly put it in the chat box for you. If you're watching the recording, go along or reach out to one of the team if there's no availability. Again, just some pictures of how we used to do this in the past. This was again in Times Square, watching an ice hockey game, Madison Square Gardens, outside the New York Stock Exchange, buying commercial property, buying houses, having some fun, meeting the partners on the ground, going to a bull thing in Oklahoma, buying more medical property, sitting at an investment committee meeting. We did $100 million with this guy alone, Paul Shalander. More commercial buildings, looking at buyers trips in Hong Kong. This is how we used to do it until we formed the mastermind. And now you can literally get access to the family office. You can get access to me and our team. You can get one-to-one coaching in terms of that process. And you can get group of a like-minded group of global citizens. And, something that I'm super proud of. We've got people from America, England, Ireland, Spain, Portugal, Italy, Germany, the Netherlands, Dubai, Saudi Arabia, South Africa, Zambia, Swaziland, New Zealand, Australia. I think I've probably got all of them. I might have forgotten. We've got a group of men and women. We've got the youngest being in their late 30s. We've got the oldest being in their mid 80s. An incredible group of people that are out there ultimately becoming global citizens. And you know what I love about it? We've got everything from highly successful business people, entrepreneurs, auditors and accountants. We've got doctors, we've got dentists, we've got farmers, we've got plumbers, we've got teachers. So like all different, we've got corporate executives, all different backgrounds, which is really, really awesome. So in conclusion, there's your formula. You've got 2 options. You can keep using the excuses. I don't have the money, I don't have the knowledge, or I don't have the time. Either one of all 3 of them, or maybe just one of them. And my belief is that at the end of the year, you'll be like this person, head in a laptop, very frustrated. Or on the other side, you can get what you want, you can get the knowledge, and you can get the time that you want. And there's a depiction of a happy family, at Christmas time, generational wealth, peace of mind, happiness, etc. If you want to go fast, go alone. If you want to go far, go together. I spoke to you today about the laws of nature. I spoke to you about Deepak Chakra. And I fundamentally love this African proverb. If you want to go fast, go alone. Remember on Monday morning, I told you about the people that stress, and try to do it all on their own. But if you want to go far, go together. Either join the Wealth Hacker community. We've given you links on how to do that. Remember the discount that you're truly going to get access to Wealth Going Global. You're going to save yourself a lot of money if you get involved this week, because when we launch that alone will be $497. And you won't get all the other pieces that I've said. Or sign up and set up a meeting to apply to be part of the mastermind, because then it's literally done with you and done for you in terms of that process. Your action steps for today. Research and identify at least 3 different investment strategies: passive investing, active investing, and value investing. Create a hypothetical diversified investment portfolio with different asset classes and allocating different percentages. So you can go do all the work if you want to. I've shown you how to do it, or consider the mastermind and have it done for you. And then share one key takeaway at the Wealthy University group. Same as every day. It's really important to share your key takeaways. And then your gold, research the different asset classes and their historical performance, and research and compare the different investment vehicles. Again, if you want to go do it all yourself, this is what you need to do. If you want it done for you, then just apply to be part of the mastermind, and they will literally do it for you in terms of that process. As always, if you want to just jump on a discovery call, literally go along and chat with one of our team members. If you're not sure, should I do Wealth Hackers? Should I do Mastermind? I'm not sure. Doesn't matter. Jump on a discovery call. The team will be able to help you with your next steps in terms of what you want. And Kelly, thanks so much for dropping the links in. And lastly, it's now time to go to the VIP. And again, if you want to upgrade, you can either join the Wealth Hackers, or you can literally just go to the upgrade. You're going to get access to everything we've discussed, including the workbook in terms of that process. These are the links. You should know them by now for the WhatsApp group and the university group. That is the formula to diversify across countries, currencies, assets, partners, and time. I'm never going to talk about the Payday Accelerator again, just for the record. So this will be the last time you ever hear about it. So if you do want to participate in that, use the link today. We won't be talking about that any further, because going forward, it'll just be the Wealth Hackers. If you do want to join the Wealth Hackers, reminding you that if you get part of this, you get access to Wealth Going Global, the new course, which is launching on the 22nd of July. So again, there's only a limited number of people. You're literally the first people in the world to be hearing about this. And then finally, if you want to join the mastermind, then you've got access to that, and you've got the link. Go and apply to be part of it. I leave you with your own decision. You've got the 2 choices. Do you want to be the guy with his head in the laptop with anxiety and stress and frustration, or do you want to be the happy family that's on the beach with peace of mind, a plan B, wealth protection, diversification, etc.? This is the framework. Remember, you need to get access to the right partners, access to the right deals, the right information, and you need diversification. And this is how you get paid. And that's why we've hopefully taken you through the whole thing today and actually shown you how to do it. The plan for day 4, this is all about risk. It's how do you manage risk and how do you find the right partners? And so it's really, really important. In conclusion, money won't create success. The freedom to make it will. I want to thank you all for your time. Today, we've got a lot more practical. We've literally gone and looked at what are the top 1% doing, not only from a philosophy of the 6 pillars to wealth, but we've also gone like, how do you allocate that? And, I'm now going to go in the Q&A. We are going to go into more detail, and we're actually going to talk about this modeling and, the different modeling and the different assets and what you should be doing per age group and why you should be doing that. So that's going to be the session now in terms of the Q&A. And as always, it's been wonderful. I really appreciate your time. I know today was a longer session. I'm sorry, but there is no way to share what the top 1% are doing and to give you the fundamentals, the foundational stuff, if I don't share with you properly what they're doing, how they're doing it, so that you can go and copy it. And again, like I've said to you so many times, we are giving you everything. You can literally go and copy it all yourself. Or if you want to work with us and our team, join the Wealth Hackers, apply for the mastermind, and we can do it with you for you. Excellent. To all of you, we'll see you now in the, and there, Kelly's just dropped a link. Remind us, Kelly, we must do it again in case anyone's jumped off. But Kelly's dropped the link to Women in Wealth as well. I know we started today with women and Women in Wealth. Kelly's dropped the link in there for anyone that wants to join the WhatsApp group, which is for women. It's about empowering women and the whole conversation about women in wealth. Anyway, I will see you all in the VIP room. Otherwise, I'll see you bright and early tomorrow. Tomorrow, in my opinion, is the second most important day. The most important day is Friday, by the way. But tomorrow is the second most important day because it's about managing risk. And, Warren Buffett always says you don't want to lose money. That's rule number 1. Rule number 2, refer to rule number 1. And secondly, for me, how do you manage risk? The most important way to manage risk is how do you find the right partners? And so tomorrow will be all about finding the right partners. Okay. See you all live in the VIP room. If you need to run to the toilet or whatever, go for it, but I'll see you there live. Cheers.